The market is not oversold yet. We think that this correction continues.
This is the problem that we're seeing. We don't have a consistent message coming from the earnings season. That's what's causing some of this volatility.
While there could be some stumbling, we are maintaining our overweight recommendation on tech.
There's likely this disconnect that's building between the earnings expectations and what's happening in the economy.
Ultimately, I think, the fundamentals matter. And I think the fundamentals sort of support this rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get your trading week started. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance begins right now with your equity market looking a little something like this. Equity futures on the S&P 500 positive by 0.3%, leaving behind 2 weeks of losses on the S&P 500, 3 weeks of losses on the Nasdaq 100, and 3 weeks of gains on a Russell. That rotation continues. We'll pick up on the small caps. Talk about a busy week. Central bank triple header, tons of economic data, payrolls on Friday, and lots of earnings from mega cap tech.
So we sometimes will come in and say this is going to be a massive week. This is actually going to be a monumental week, arguably the most important week going until Labor Day, because what you're looking at is not only Fed decision, not only some of the jobs data that we get, but also about 20% of the S&P in terms of big tech alone, more than 30% of the S&P 500 reporting overall just this week alone, John.
20% of the S&P across four names.
That's what I'm saying, yes.
Super clear about that. When we're talking about tech earnings, we're just talking about four names: Microsoft, Meta, Amazon, and Apple. A big question we'll be asking through this morning: what's more important here, the Federal Reserve decision on Wednesday, payrolls on Friday, or the earnings in between? Stuart Kaiser of Citi making the point that he believes earnings will set the tone, Lisa, for sentiment going forward.
And a lot of people would agree with him. Pretty much across the board in the notes over the weekend, people are saying, look, when you have 20% of the index reporting in four names, you have to imagine that it's important, especially because of what we saw from Alphabet, from Tesla, and sort of the disappointment that was imbued into markets. There is a key question here, and it is multi-pronged, and it's hard to divorce the two, which is how much are people lowering the bar for big tech, and can they supersede that? And the second one is, how confident can we be that we actually are in Goldilocks? The Goldilocks is getting tired narrative is there, but people are still clinging to that Goldilocks that is allowing that rotation to continue.
It feels like Wednesday's pretty well understood at this point with the Federal Reserve and a prospect of interest rate cuts in September. The focus has shifted now to growth. Mike Wilson and Morgan Stanley making this point this morning, which is why I'd point out payrolls on Friday. Payrolls on Friday is the difference between the September rate cut being the right kind of rate cut and the wrong kind of rate cut. The right kind of rate cut being you've got inflation coming in, the labour market's still strong, it's a mid-cycle adjustment. The wrong kind of rate cut being unemployment's starting to shoot higher, they're super concerned, and they're reacting to it, not getting ahead of it. And that's the point that you made on Friday going into the weekend.
It's incredibly difficult to parse this out because when you take a look at GDP coming in stronger than expected, when you come in and look at what personal spending is, real spending, it isn't necessarily falling off a cliff in any way, shape, or form. So people are having trouble really coalescing around this is truly a growth scare. Andrew Hollenhorst over at Citigroup says, just wait, and the labor market will be what you actually see. And he's expecting 3 rate cuts this year, and he's expecting a terminal rate next year of something like 3.5%. This more aggressive view that talks to that more quickly kind of decelerating growth that leads to a negative payroll.
He's looking for unemployment to shift a little bit higher as well on Friday, so look out for that. Are you all looking forward to seeing the back of July? I think I feel that way about July. It's like this month has just gone on and on and on and didn't have many weekends at all, ever since the July 4th weekend.
Do you want to talk about it?
Just like like therapy time.
Yeah, I mean, let's
time
talk
on
about
Monday morning.
What this month.
Thanks for tuning in and welcome to the programme. Allow me to talk about my feelings.
All right.
Start with the price section. Equity futures look like this on the S&P. We're firmer by a third of 1%. Here's the bounce. Yields are lower. We shave a little bit more off a 10-year yield. We're down 3 basis points, 415.89. And in foreign exchange, the euro a little weaker here, breaking down in the last 30 minutes or so, 108.37. I think the one to watch through the week going into the BOJ. Lisa, dollar yen at 153.
Massive. We'll get to that in 1 second. Let's just put this into 3 different buckets. We've got the economic data, we've got central bank decisions, and we've got earnings. From the economic perspective, today we get the the quarterly refunding borrowing estimates. Tuesday we get U.S. June JOLTS report earnings from Mike. We also get, of course, Wednesday, U.S. ADP report, as well as the Q2 employment cost index and that Treasury refunding statement. Some people say that might be the most important aspect of this week.
Some
but I know
people.
I'm biased on that front. front. On Thursday, we get jobless claims and ISM manufacturing. And Friday, as you're mentioning, that July non-farm payrolls report. Then when it comes to central banks, you get the Bank of Japan coming out. Crucial. What is the potential disappointment factor in the yen if they do not hike rates? Or is the balance sheet potentially going to be more important? Also on Wednesday, we get the Federal Reserve. And on Thursday, we get the Bank of England, which you could discuss how important that's going to be among the three. And then from the earnings, more than 30% of the S&P 500 is going to be reporting this week, 20% of which is 20% of the S&P 500 is going to be for names. On Tuesday, we do get earnings from Microsoft. On Wednesday, we get earnings from Meta. And on Thursday, we get Apple and Amazon, John.
My favorite week of the quarter, just a blockbuster week ahead of us. Coming up this hour to break down all of this, Marvin Lowe of State Street ahead of us, trio of central bank decisions, Terry Haines of Pangaea Policy on the short list of running mates for Vice President Kamala Harris, and Lindsey Piegza of Stifel saying back-to-back months of cooler data may be enough for the Federal Reserve. We begin with our top story, investors preparing for a busy week of earnings from big tech and a trio of central bank decisions. Marvin Lowe of State Street expected the Fed's first cut to come in December. He's got this to say: this is not the meeting to pre-signal a September cut. The calendar is still in the Fed's favour, but also, and more importantly, data is mixed. We still hold on to December. Marvin joins us now for more. Marvin, good morning to you.
Good morning. How are you?
Lisa did a wonderful job of going through the week ahead. The data, the earnings, the central bank decisions. If you could pick one right now, what would you like to know this morning?
I think earnings are important. I think that, for the most part, the communication policy from the central banks, especially the Fed, are pretty robust these days. So, Wednesday will come and go, and there really won't be that many surprises. But given how volatile these earnings have created an environment in the market, they're important.
Something to everyone in the earnings over the last few weeks, for both the bulls and the bears alike. I think the one question we've asked on this programme repeatedly over the last month or so is worth repeating again this morning. Are things cooling or heading in a bad direction? Which one is it?
I think things are still fine, to be honest with you. Like the wheat and the chaff when it comes to earnings is like you've got earnings and then you've got really the valuation around them. The earnings have not been terrible. Granted, maybe the market got ahead of itself. Certainly valuations, practically everyone has been talking about how frothy they've gotten. But the story around earnings, the story around U.S. exceptionalism because of these companies is still retained in my mind.
Well, this again goes to this question of, can the Fed give some sort of concrete message, or is it basically going to be a very neutral one that truly leaves open the fact that Friday and the next payrolls report that we get before the next Fed meeting will be pivotal in making the decision? Essentially, this is going to hinge on one or two data points about whether they go in September or not.
Every data point is live. They've been telling us that, and for sure, the data remains mixed. There have been signs of slowing in the economy, for sure, and the markets have gotten excited about that. But GDP shows that the retail consumer is still engaged when you kind of look at those big components.
All right, so let's put the Fed aside, or raise this question to you. Mm-hmm. Which is more important, the Bank of Japan or the Fed, to potentially disrupt this market?
The Fed still. I mean, certainly if you're trading dollar yen, you're going to say that the BOJ is the most important thing to think about. But really, the Fed is going to set the tone for everybody else. And our view is that while the BOJ certainly needs to start to normalize policy, they don't have really that many levers to work with. I mean, they're dealing with 30 years of unconventional monetary policy that they're slowly trying to unwind. And I think that's why we keep talking about them in this waiting period, because it's that hard for them.
Okay, so here's the issue. John's going to laugh at me, but I kind of have to go here. I'm sorry, John. I think that a lot of people think that I'm overly obsessed with
Is this Treasury refunding?
Maybe.
Okay.
So
I'm a race guy, so I appreciate that.
No, I know.
He's ready to go.
Okay. This is important, right? Yeah. I mean, this could potentially be market moving almost more so than a lot of the other potential events. I mean, arguably, this could be as important as earnings, no?
QRA this month and this quarter is not going to be the most important aspect. We're not going to get a whole lot of changes, but really thinking through how this cycle is going to wind up and who's going to wind up buying all these treasuries is going to be the most important thing that we really think about. Because if the BOJ is buying less treasuries, less JGBs, somebody else has to buy them. And if those buyers are treasury buyers at the moment, when we kind of think through this going into 2025, you have to ask your question, who's going to wind up picking up this increase in treasury issuance, which really starts to ramp up in the middle of next year?
Smells like bear steepening in 2025. Is that what it is for you?
Yeah.
So that goes against the grain at the moment, because what we've seen
does.
over the last week is the bull steepness, or a big rally at the front end of the curve last week. Why do you take a different perspective on this?
Well, number one, rate cutting cycles have a massive tailwind for everything. They're that important. So, the natural gravitation to go long duration during rate cutting cycles is something, you just don't fight. But when we had the volatility last Wednesday and we had long yields going higher, you really needed to ask the question, is the relationships that exist between duration and risk what it used to be? And I really do see a number of things from the perspective of the BOJ, whether or not they force less Treasury buyers to kind of come out of the market, whether or not you talk about debt sustainability, whether you talk about a new inflation paradigm, for instance, where housing is no longer as stable as it used to be, because it's going to take a long time for this housing market to stabilize, and that has an impact on inflation volatility.
What you're saying will have huge consequences for asset allocation.
Yes.
Are you suggesting that in 2025, Treasuries won't have risk mitigation characteristics in a drawdown in equities?
I think that you've seen that for the better part of this year, and you've been able to ignore it because rate cuts are that important to the story. But once we get to either the midpoint or the end of that story, you really ask yourself, where are they at the end, and how much of it do I want to own?
So what is the risk mitigation? Is it still the dollar? Is it Bitcoin, given the recent conference we've heard from the former President Trump?
Yeah, I'm not a crypto advocate, so I'll kind of stay off of that. I think equity allocations themselves have the potential to be much higher, but currencies also, certainly from a perspective that we haven't seen before.
Marvin, before you go, give me a 10-year yield target for next year. What kind of numbers are you and the team thinking about?
I think 5.25 is something that we should think about.
Back to 5.25 on a 10-year.
Yeah.
Is that politically independent or politically dependent?
It is politically independent from a perspective that both parties are bad actors in Washington.
OK. Marvin Lowe of State Street. Marvin, good to see you.
Thank you.
Quite the call on the 10-year for next year. Equity futures, if you are just joining us, welcome to the programme. Big week ahead. We're positive by 1/3% on the S&P 500 with an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Nicolas Maduro has been declared the winner in Venezuela's presidential election by the Electoral Authority, which is overseen by the ruling regime. The opposition is rejecting that claim. It called on the military to enforce what it said was the will of the people. The U.S. and some Latin American neighbors have also raised concerns. U.S. Secretary of State Antony Blinken called for a detailed tabulation of votes, saying it's important every vote is counted fairly and transparently. And Donald Trump is courting cryptocurrency enthusiasts in his bid to return to the White House. Speaking at a Bitcoin conference in Nashville on Saturday, Trump said he would ensure that the United States will be the crypto capital of the planet and the Bitcoin superpower of the world. The crowd cheered loudly as Trump said if he wins the election, he would fire SEC Chair Gary Gensler, whose term isn't up until 2026. And it was an eventful opening weekend at the Paris Olympics. Simone Biles and Suni Lee stole the show for U.S. gymnastics, both qualifying for the all-around final. Kevin Durant powered USA basketball to win over Serbia. And the U.S. secured its first gold with the men's 4x100-meter freestyle relay. Officials did cancel water training in the Seine on Monday after the rainy weekend elevated pollution levels in the river. Overall, the U.S. currently leads with 12 medals overall. 3 of those are gold. China, Japan, South Korea, and Australia are tied for the lead in gold medals with 4 apiece. And that's your brief. John.
Danny, appreciate it. Thank you. More from Danny in about 30 minutes' time. Up next on the programme, ramping up the search for a running mate.
Well, I'm not speaking on anything personal on this. I think being mentioned is certainly an honor. My job is to make sure that, and I trust that Vice President Sarah's judgment, she'll make the best choice she's going to. But one way or another, she is going to win in November.
That conversation up next. Live from New York City this morning. Good morning.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom.
At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
Live from New York City, welcome to the program. Good morning to you all. A brand new trading week ahead of us. Equity futures right now positive by about 0.4%. That's the bounce. Yields a little bit lower by 3 basis points, almost 4. We're down to 415.89 on a 10-year. Under surveillance this morning, ramping up the search for a running mate.
The fact of the matter is, where you see the policies that Vice President Harris was a part of making, Democratic governors across the country executed those policies, and quality of life is higher, the economies are better.
Have you received vetting materials from the Harris campaign?
I'm not speaking on anything personal on this. I think being mentioned is certainly an honor. My job is to make sure that, and I trust that Vice President Harris' judgment, she'll make the best choice she's going to. But one way or another, she is going to win in November.
Here's the latest this morning. Bloomberg reporting presumptive Democratic nominee Kamala Harris is down to 3 potential running mates. Senator Mark Kelly of Arizona, Governor Josh Shapiro of Pennsylvania, and Governor Tim Walz of Minnesota. The latest polling from ABC News showing an 8 percentage point jump in favorability for Harris over the last week. Terry Haines of Pangaea Policy giving Harris a 60% chance to win the White House, owing to 3 things: strict discipline from Harris on messaging, serious Democratic turnout, and a VP pick that broadens the ticket's appeal to independent voters. Terry Haines of Pangaea Policy joins us now for more. Terry, it was your base case when Biden was running that he'd edge this, and it seems like even more so now with Harris, this is your base case that Harris edges this. What is it about Harris that makes this race much more winnable for the Democrats than it did under, say, Biden?
I think there's really 3 things. There's firstly, there's enthusiasm within the Democratic base. Democrats are already coming home, and I think they've come home to stay. Secondly, the social issue platform really appeals a lot to independents. I think a lot of the economic messages are frankly baked in, but what you got is, you got a situation where, this was already in place, where you're going to scare people about their freedoms, and that's the catchphrase of the catchword of the Harris campaign already is freedom. And you're going to do that, and then you're going to play into Trump fatigue as well. And finally, I think there's just what I called in the piece the thrill of the new. When we've always talked about double haters and how much people didn't want this race to happen, and all of a sudden there's a big alternative and a generational alternative, and I think that plays into it as well.
Terry, even when, just to John's point, even when Biden was still running, you really didn't think that Donald Trump was going to win. You thought that either way, you would have Biden eke out some sort of victory. Why is it, and what can you point to, that there is actual Trump fatigue at a time where he really has managed to increase his donations, has garnered a lot of big sort of corporate backing? What gives you that sense that he's really running out of steam?
Well, I think a lot of what you mentioned, including the fundraising, is pretty transactional. What I've looked for all year is very simple. Trump's base does not equal the Republican Party, for example, and you saw that in the primaries, where 20 to 40% of people were voting for somebody other than Trump, mostly Haley. But does he consolidate the Republican Party? Does he unify it? And can he appeal to the majority of independents? That was the winning formula in 2016. That was the losing formula in 2020. So far, that formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party, I think. Number one. Number two, the vice presidential pick doesn't help with that. That's not transformational. That's small ball, which in turn makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
Is there going to be a September debate, Terry?
I think, I would say so. I'll give you 80% that there is. Sure. If they're haggling about which network it's going to be on, they both said yes, and that's the bottom line.
Terry, how do you think the message changes from the Trump campaign?
I think they're struggling for that right now. I think they try to double down in a way that isn't personally insulting to Harris on her lack of experience and all the rest. They move a little bit more. Trump will move a little bit more presidential. Kind of, I've been there. I've seen it. I know what to do. He never talks about how he'll do it, of course, but I know what to do. They will exploit Harris's lack of experience in foreign policy. They'll denigrate the border. They'll hammer much more on economic messages and, frankly, border messages, and make the point that the administration of which the vice president is part, made the country markedly worse. So it'll be a little bit of shift in tone, but not a shift in messages itself.
We've seen plenty of twists and changes in this election race in the last month. I wonder if we could see another one. Do you think the former president sticks with his running mate, Terry?
Oh yeah, I do. I mean, I think that pie's already baked. But there's a lot of regret there already. As I said within an hour after it happened, it's a mistake because it's political small ball and it doesn't expand Trump's appeal, and that's really come home just in the last week or two, and that'll get emphasized even further with a pick of the kind that you've already talked about in the intro.
Can we talk about Bitcoin, Terry? Can we talk about crypto? It wasn't on my bingo card that suddenly this crypto conference was going to be sort of a massive rally for Donald Trump. Really, I was really struck Friday by this crypto conference where Trump raised a lot of money. He talked about the importance of crypto assets and being on the technological forefront of all of the new developments. Do you understand kind of what this message is geared at, whether it's just a fundraising tool or whether it's something more substantial?
I think it's primarily a fundraising tool, and it's a way to continue to generate enthusiasm among kind of Silicon Valley backers. And if you think about crypto and Bitcoin and the like as kind of an adjunct to tech, which it is. It looks that way, sure. But fundamentally, I think the enthusiasm is overblown. All these folks have been looking for 4 years for a horse to ride ever since, they thought they were the grooviest people in Washington in 2020. And then they couldn't make anything happen at all. And the administration was obviously hostile to what they wanted. So now what you see is a lot of sentiment saying, oh, well, this will be the crypto president. This will be this, that, and the other. The path forward there is much murkier. The institutional folks who want to defend the sovereign currency, I think, are a bigger obstacle than Trump believes.
Well, to that point, Terry, is there any connection to the sort of focus on weakening the dollar, on Donald Trump saying that the dollar is too strong, and the support of crypto assets?
Well, I think that's a very valid point. And, my view of Trump generally is that, if he was a painter, he'd be Jackson Pollock. If he'd be, if he was a cook, he'd be, throwing the spaghetti up on the wall to see what sticks. And I think that's pretty much what you got here.
Terry, thank you, sir. Terry Haines of Pangaea Policy with some constructive views at the end there on how he'd frame things. I'll try and frame things. We did this on Friday around the Bitcoin issue. There is a kind interpretation here and a less kind interpretation here. The kind interpretation is that the likes of Donald Trump, if he becomes the president, gets a second term, he'd be supportive of the ecosystem. It would be beneficial to the US economy. I'm sure we'll hear plenty of those arguments. The less kind interpretation is they're supporting the former president because they believe he has a set of policies that may destabilize the US dollar and benefit the likes of Bitcoin.
The destabilizing of the U.S. dollar is one of the key questions, especially because of the 1-2 punch of in the same week where he's talking about the importance of a weaker dollar. You also have a real focus on the importance of building out crypto assets. Look, I don't know that anyone is actually saying he's looking to destabilize the U.S. currency in order to allow crypto assets to come to the fore. That I don't think is on a lot of people's sort of list of likely scenarios. This is this question of what policies can you hook your teeth into that are likely to come from the former president. Janet Yellen, Treasury Secretary, responded to some of the discussions around the dollar over the weekend, saying a very strong dollar can discourage exports and contribute to imports. But there's a lot more that's involved. And I think you have to ask, why is the dollar strong? That, I think, is really the key question.
There's been some pushback against this theory that there is some activist Treasury issuance going on as well. I saw that on Friday.
Which will be in the 4 today and on Wednesday.
Of course. The big announcement coming up this week, never mind the data, the earnings or the central bank decisions, it's the quarterly refunding announcement.
Absolutely. It's really big. Yeah. It's a big deal. Did you hear Marvin Lowe basically
He said it was like the issue of this week.
Maybe not this
of the
week.
year and maybe even the decade. Coming up, investors betting on a Fed rate cut in September while looking for clues from the BOJ on whether they're going to hike. That conversation up next. just a little bit of outperformance on the Russell, the small caps again this morning. A whole lot of that over the last few weeks. The Russell up by 0.6%. The Nasdaq up by 0.6%. Also, the S&P up by 0.4%. The scores so far going into the end of July. The Russell's up 10%. The Nasdaq's down 3%. And if you take it from the record high on the Nasdaq from earlier in July, that discrepancy is even wider.
Yeah, that's down about 8% on the NASDAQ. Just the Mag 7 alone over the past 2 weeks is down 12%. That's where the declines really have been, led by what we saw from Alphabet and Tesla. This fear that a lot of these tech giants cannot supersede expectations at a time where they're spending on things that can't happen overnight.
Are they going to be rewarded for that or punished for it? We've got a flavour of things just in the last week or so after Alphabet. You get the sense that they might be punished for it. Coming up later this week. We'll look out for that with the likes of Meta and Microsoft and Amazon and Apple, all still to come. Let's turn to the bond market. 2-year, 10-year, 30-year yields are down by about 4 basis points. We shaved some more yield off the front end of the curve. We're down about a basis point to 436.68 on a US 2-year, down 12 basis points last week. That so-called bull steepener kicked in with a big rally at the front end of the yield curve. If you missed the conversation from about 20 minutes ago, Marvin Lowe of State Street suggesting that in 2025, you'll see something different. You'll see a bear steepener. He's looking for the long end of the curve to sell off. He's looking for the 10-year yield to breach 5% again off the back of the things that you've been talking about, the supply story out of the Treasury.
Thank you. I just want to say thank you because I do
That's why I'm teeing it up.
Thank you. You did a fantastic job. To me, really, the question is going to be quantitative tightening, which is essentially what's happening. And this idea of rate hikes has a really big consequence when it's global. And when you get a pool of treasuries that is increasing at the pace that it is, who is going to buy them? So far, it has not been a problem, but at some point, pretty much everyone agrees, you will start to see some sort of extra premium built in to compensate for a record amount of treasury issuance. Today, maybe not in terms of the quarterly refunding estimate that we get later today. And then on Wednesday, we get the actual schedule of sales. To me, though, longer term, this will be the question for the long term.
Synchronized QT.
Exactly.
Not an Olympic sport. Switch at the board and get to foreign exchange. We'll talk about dollar yen. Sound like a dad joke, I'm sorry. Dollar yen, 153.87. Bramo liked it, that's who it was for, all right? Dollar yen last week down by almost 2.4%, the biggest weekly decline since May. In fact, that currency pair has been lower for 4 consecutive weeks. And Lisa, that is the first time we've seen that this year. That is some real yen strength going into this BOJ decision.
Which raises this issue of how high is the bar for the Bank of Japan to meet those expectations that they will respond to the weakening in the yen in the way that the market is anticipating. Bantheon Macro said that the Bank of Japan will probably placate currency investors by cutting back bond buying on Wednesday. However, and this is the rub, but will likely stay put on the policy rate in order to prop up growth and foster demand pull inflation. This has been the issue. The economy has been sort of on the margins, not necessarily showing the same kind of dynamism. So do they really have the confidence to hike rates? Will they lead on the balance sheet?
There's some real division going into Wednesday. I have to say, you mentioned Pantheon, this from JP Morgan. They see the BOJ hiking this week and a big cut in bond buying as well. That just shows how split things are going into Wednesday. That's the BOJ. Of course, we've got the Federal Reserve and the Bank of England a little bit later this week too. So that's the story in foreign exchange. Under surveillance this morning, one of our top stories worldwide, Israel threatening further retaliation against Hezbollah after striking targets in Lebanon yesterday. The move comes in response to a rocket strike which killed 12 children and teenagers in the Golan Heights over the weekend. Meanwhile, talks continue for a truce in Gaza. A conversation we had last week going into the weekend is that we seem to be equidistant between a truce in Gaza and an escalation in Lebanon. And that's how finely balanced things are in that region at the moment.
You know, this is hugely concerning, and a lot of people are looking at it from a humanitarian standpoint. It's the biggest loss of life for Israel going back to October 7th. From a strategic standpoint, this has been the sort of big question. This has been the elephant in the room. What happens with Hezbollah at a time when Israel is trying to defend its northern border? The issue here, to me, is at what point can you cool things down when mistakes could happen? Peter Scheer has been talking about this. When you start doing tit-for-tat missiles, mistakes happen, and you can escalate without meaning to. And that, I think, is the fear. And Peter Scheer has pointed to the geopolitical risks at a time where there are a lot of question marks about how continuous the leadership is going to be in the world's biggest economy.
Oh, big question marks about U.S. leadership. Things are fragile, really, really fragile in that part of the world. I want to turn to this story. Going into Apple earnings later on this week, people familiar with the matter telling Bloomberg that Apple's upcoming AI upgrades will be delayed. New features now being released in October after software overhauls for the iPhone and iPad in September. Early testing for developers will still happen as soon as this week. To put this in sort of plain English, Lisa, are we saying that the iPhone comes out in September but without the good stuff coming from AI?
Yeah, and when you say the good stuff, it is really the main story of what the iPhone 16 has to offer. Our own Mark Gurman has already reported that other than the AI changes, the iPhone 16 line doesn't really have much by way of design difference from the previous iterations. It's leaned entirely on really artificial intelligence upgrades, other than just having a faster chip and a different way of controlling the camera.
So the point you're alluding to is basically all the bullish calls out there. Dan Ives, Wedbush, has made this call repeatedly that we'll get this big upgrade cycle. When we finally get this big evolution in the iPhone, that's going to be delayed?
Essentially, yes. I mean, one could make the argument that if they're delaying it to make sure it's perfect, which has been Apple's tradition, right, that basically they try to hone it so that it doesn't have, huge snafu that's embarrassing, then potentially it's not a problem if you wait an extra month. If you delay it for a month, it's not a big deal. If it's that they're having difficulty understanding what AI could potentially be deployed in a convenient way that actually is a must-have, that becomes a more sort of existential question.
That stock is just a little bit softer in pre-market trading. Later on this morning, I think in the next hour or so, we'll catch up with Ed Ludlow from the West Coast, actually here on the East Coast in New York, to break down some of these issues that's taking place with Apple and looking ahead to the earnings from everybody else. For everybody else, we'll be looking at a trio of central bank decisions on deck. The Fed and BOJ on Wednesday, the Bank of England due on Thursday. Steve Englander of Standard Chartered saying the Bank of Japan may be teeing up for a rate hike in September, saying the market will be happy enough if they give a wink and a nod. Steve joins us now for more. Steve, is that what we're looking for this week? Winks and nods to September for both the BOJ and the Federal Reserve going in opposite directions?
Exactly. One doing the left eye, the other doing the right eye. I think the Fed is going to leave the door open and sound encouraging, but they certainly don't want to sound committal. They're going to wait and make sure that the data kind of are reasonably consistent. But, it does sound as if they would like to cut in September and justify the market's views. So, with a lot of trepidation, this looks like a layup in terms of meeting market expectations and not jarring the market too much. So I wouldn't expect too much fireworks out of it. BOJ, more interesting. We don't think they're going to cut, we don't think they're going to hike. But the market only has like 12 basis points priced in for September. So if they give enough of an indication, that we just don't want to talk about tapering and do a rate hike at the same meeting, we think the market will be comfortable with it as long as they don't lowball the tapering.
So, Steve, let's take dollar yen, just short of 154. A wink and nods on both sides of that currency pair sufficient to keep this trend intact, maintain this journey back towards 150 and maybe below?
To really get it moving, they would have to hike. We don't expect that, but that's the risk. I think to keep it where it is, and given that they've upped the importance of the exchange rate, I think the kind of wink and nod that, you alluded to, I think that that's going to be enough, maybe to keep the yen sort of slightly stronger, not enormously stronger. I think for that, we would need them to show that, they are moving and that they're moving more aggressively than is now priced in.
Just to sort of underscore that, Steve, are you saying that they are not going to hike rates and that will sort of be okay for the currency market, or they're not going to hike rates and that's going to be devastating for the yen and it's going to go back to where it was versus the dollar, say, 2 weeks ago?
Look, to devastate the yen, they would have to put September in question. And I don't think that's going to happen. To sort of, but given that if you look at the market pricing, yes, they have like 5 or 6 basis points priced in for this week, but they only have 12 in total for September. So I think if the market walks away saying, yeah, they didn't hike, we didn't really expect them to, but they're good for September, I think that's going to be fine for the yen. Like a bunt single. It's not going to be a triple or a home run.
How much does the balance sheet matter? Pantheon Macro talking about how that could placate the market if they just stop buying as many bonds. Do you agree?
Well, I think they have to, given that they sort of justified doing nothing last time by promising that they're going to lay out their path. And they do have to sort of announce a significant cut. If they, the other down or risk for yen weakening is if the the pace of balance sheet reduction is so slow that the market says it's not meaningful. But again, we think that they will give enough of a indication of the pace on the balance sheet, front-loaded enough that it should be all right for the yen. I think that it's going to be consistent with market expectations.
Steve, that's bond buying in Japan. It could have some implications for the kind of buying that takes place here in the United States as the supply starts to ramp up. Steve, you've seen all the articles, all the studies on the so-called activist treasury issuance. Steve, what's your understanding of what ATI actually is and how much weight do you put on it?
I think ATI is a modern version of, what was done 60 years ago in terms of Operation Twist, that you kind of reduced issuance at the long end, takes the pressure off the long end of the bond market, you issue at the short end. And that's, kind of, you end up with a flatter yield curve. And you can kind of see that that's what they've been doing the last couple of years, except that they haven't been doing it the last couple of months. So it's one thing to say that they're trying to take the pressure off the long end, but given that they haven't been doing that kind of issuing this year, it's not an explanation for why 10-year bond yields are 4.15 now, down from 4.70 at the end of April. Also, I think that they overstate the impact, or some commentary overstates the impact in the sense of talking about it being equal to 100 basis points of cuts. I think that that's not quite there, because what we've seen, the experiment that's being run, even if you assume 25 basis points at the long end, is what if the long yield goes down by 25 basis points and Fed funds is held flat? It's not, let's cut Fed funds by 100. That's going to take the long end by 25, and that's going to have a big impact. I mean, intuitively, we've had the long end swing 25 basis points 4 or 5 times this year, and we haven't seen any trauma in the market. People like us have trauma. People in asset markets worry about it, but it's not as if economic activity seems to be visibly affected by that kind of move at the long end, as long as the Fed isn't actually moving, and now the market's waiting for the Fed to move.
Well, Steve, let's flip this on its head. What if the Treasury comes out this week and says that they're much more heavily weighting the issuance going forward to the long end? How big could the reaction be in terms of yields rising on the 10-year, on the 30-year?
Well, I think the market kind of expects, them to continue in the direction that they've been going. Lately, if they do issue at the long end, a lot, I think it could matter. But I actually think it's more second order. I mean, it matters, but it's not, and it's going to matter in terms of, do yields stay at where I just saw them, like 4.15, 4.17? Probably not, but it's not going to take them to 4.70. It's going, 10 basis points, 20 basis points maximum. Again, it matters, but it's a second order in terms of the economy.
Down to about 4.16 this morning. Steve, it's got to catch up, sir. Steve Englander there of Standard Chartered. Yields down across the curve. We're down 3 or 4 basis points on a 10-year this morning. On a 2-year, down a single basis point. Your yield at the front end of the curve, about 4.37. With an update on stories elsewhere this morning with your Bloomberg brief, let's cross over to Danny Berger. Hey, Danny.
Hey, John. Heineken shares are lower this morning, 7.6% in the European trade. The brewing giant's first half profit growth came in weaker than analysts had expected. Beer sales were expected to grow 3.4%. Instead, they rose just 2.1%. Heineken also took a nearly $950 million charge for a decline in valuation of its stake in China's largest brewer. It also flagged that U.S. weakness is clouding its prospects. Meanwhile, Alibaba shares the ADRs are rising by the most in 2 months, 1.5%. It announced plans to boost service fees for merchants. Alibaba will start charging a basic software service of 0.6% for the fees on confirmed transactions for vendors on the Tmall and Taobao platforms. Merchants learned of the policy change on Friday, according to a person familiar. But Alibaba may waive the new policy for small merchants, the person said. And the FT is reporting that Swiss drug maker Roche is fast-tracking its weight loss pill. The company's CEO told the FT its plans were motivated by encouraging data. It had a study that showed 6.1% reduction in weight only after 4 weeks of using the medication. Roche hopes it can get its pill to market by 2028 and compete with the lucrative drugs made by Eli Lilly and Novo Nordisk. And that's your Bloomberg Brief. John.
Danny, thank you. We'll see Danny again in about 30 minutes' time. Up next on the programme, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy.
That conversation up next, live from New York City. You're watching Bloomberg Surveillance. Just a sneak peek of the payrolls guesses for Friday. The median estimate in our survey is 178. Top of the pile, Mike Gape and Bank of America at 225. Perhaps no surprise because Mike Gape and Bank of America is still sticking with December for that first interest rate cut.
And saying that the economy is fine. It's sort of this huge division that we see breaking out between those who think that the economy is on the precipice of really deteriorating and others who say, did you see the GDP or did you not see the GDP that we just got?
Citi at the low end at about 150 and they're looking for a cut in September. The scores look like this in the equity market on the S&P 500, up by 0.4%. The bond market rally continues on a 10-year yield to lower by 3 or 4 basis points. The 10-year down to 415.89. Under surveillance this morning, setting the stage for September.
I think rate cuts are definitely coming. I just think that at this point, there's not a really strong case for waiting. I think it's time to start to focus on the risks of the economy, the risks of the labor market, to minimize the risk of recession, which always occurs when the unemployment rate goes up by more than 0.5% on a 3-month moving average basis.
So here's the latest going into this big decision later this week. Investors widely expecting the Fed to hold rates steady at a meeting on Wednesday and set the stage for a September rate cut. The decision coming just 2 days ahead of another key data point, the July payrolls report. Lindsey Piegza of Stifel writing this, coupled with the Fed's assessment of cooling labour market conditions, 2 back-to-back months of improving disinflation may prove to be sufficient justification for Powell to offer the reprieve investors have been desperately awaiting. Lindsey joins us now for more. Lindsey, let's get straight to it. Wednesday, everyone expecting this baby step towards a September rate cut. What do you think that baby step looks like in that news conference Wednesday?
Well, if the Fed wants to open the door to a September rate cut, they're going to have to adjust 2 main key points in the statement. Remember, in June, they said it's not appropriate to cut rates until they have needed confidence. And they also characterized the improvement in inflation as modest. So we're going to have to see the Fed back off from that need for further confidence, suggesting that they're at that point. And they're also going to have to increase their assessment of the level of improvement in terms of disinflation. Those are going to be the 2 key points to really suggest that the Fed is gearing up for a rate reduction in September, despite all of the relatively solid data as a backdrop.
The backdrop also including a lot of warnings, Lindsey, that the labour market's about to break and they need to get ahead of it and cut interest rates at this meeting, this week, this month, in July. Do you think they start to put even more weight on the other side of the dual mandate at this meeting?
Well, they have been pretty clear. We've heard from Powell that the dual mandate, stable prices, full employment, have come into better balance. And so they are going to be focusing on both of those mandates as opposed to just reinstating price stability. But that being said, the labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We have seen less tight-ish conditions relative to the start of the year, but we're still talking about a circa 4% unemployment rate, near 4% wage growth. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market. So you couple that with inflation that has been stubbornly elevated, showing now only 2 consecutive months of improvement, with the core PCE stuck at 2.6%. very little justification for the need for a rate cut at this point, despite the fact that the Fed may in fact move forward, as this is clearly a committee desperate to provide relief.
So that's where I wanted to go with you, Lindsey. Within some of your commentary, you said the Fed is offering up, perhaps, if the data cooperates, the reprieve that investors are desperately hoping for. Do you think that if the Fed ends up cutting rates sooner than later, not necessarily this month at this week's meeting, but maybe in September, that would be a mistake really aimed at placating markets?
I do think that this is a Fed that is desperate to try and achieve that utopic soft landing. And Powell has been very clear, the committee in general has been very clear, that they understand that the risks of cutting too late may create unnecessarily large burdens for the economy, potentially leading to a downturn or an outright recession. But the committee has also recognized the risk of cutting too soon or too much, because that could allow inflation to come back. That could allow inflationary pressures to become more embedded into the U.S. economy. So when we talk about the risks, absolutely, there are risks of the Fed waiting beyond September, even waiting beyond December into 2025. But if we're talking about the risks of a potential downturn versus reinstating price stability, well, as we've heard time and time again from the Fed, without price stability, the economy doesn't work for anyone.
You know, Lindsey, we've been looking into the earnings and trying to listen to what companies are saying. We've heard from airlines that say that they can't charge consumers as much as they have in the past. We hear from auto manufacturers that the issue is just how much can they cut prices to compete, to move cars off the lots. Where are you seeing signs that there really is this sort of resurgent inflation waiting in the pipeline at a time where a lot of companies are talking about price cuts, not price hikes?
Well, I think when we're talking about price cuts, we're talking about less price acceleration. Remember, prices are still rising in most cases when we talk about broadly across sectors, but it's that lack of downward momentum that we're trying to get from a monetary policy or from a corporate standpoint, that lack of upward pressure that they have been able to instill and continue to pass on these rising prices to consumers. But again, when you're talking about the indications of resilience, let's look at the consumer. The consumer momentum actually picked up from Q1 to Q2, suggesting that there is still a good amount of borrowing power, investment power, spending power out there in the U.S. economy. And that suggests that without indications of the consumer significantly faltering, the Fed still may not have done enough to reinforce the notion of instilling price stability, not hoping for price stability with a slower pace of disinflation, but getting us back to that 2% target.
Lindsey, I'm perhaps more interested in the Fed speak after the rate decision and after the payrolls report on Friday. And I'd love your view on this. I'm not saying it's your base case. I know it's not. I just want to understand, if we triggered the SARM rule on Friday, are we going to see a bunch of Fed officials run around saying, don't worry about it, it's not about demand, it's about supply? How do you think this is going to work?
Well, I think we're going to see two different storylines from Fed officials. As we saw via the dot plot, there's this growing dichotomy between Fed officials, those that are increasingly concerned about weakness, emerging weakness in the labor market, and those that are more focused on reinstating price stability. So if, in fact, we do see a weaker than expected payrolls report on Friday and we do trigger the SARM rule, I think you're going to hear two storylines. Don't look over here, continue to focus on inflation, and those that are saying, I told you so, we need to move sooner rather than later.
Lindsey Piegza of Stifel. Lindsey, appreciate it. Appreciate the input.
Thank you.
A little bit of scenario analysis at the end there. I know one individual who will be saying, look at it and make a move, and that's Andrew Holdenhorst of Citi, because he's the one guy looking for 4.2% on Friday.
Yeah, and that triggers a SARM rule. We've talked about sort of the psychological impact of that. People have differing degrees of sort of predicting how the markets are going to respond to that. Nonetheless, he's been calling for a more rapid cooling. I think the JOLTS number might be as important in some ways. We get that tomorrow, the job openings and how much they're coming down is sort of a real-time look at how much companies are adjusting their labor market needs at a time where there definitely is cooling growth.
I think you nailed it by bringing up the companies we've heard from so far. Can we get a clean read on where the consumer is at in America based on what we've heard from the airlines, the automakers, and some of the consumer-facing companies?
Absolutely not. I mean, this is the issue, is that you've seen incredible price increases in a lot of these cars. You've seen incredible price increases in some of the routes that we've seen with airlines. You see on the margins that things are maybe getting less frothy. Can we make that extrapolation, though, from this commentary that things are falling off a cliff, that people aren't traveling, that they're not buying cars? Nah, not really.
Cooling, not cool. How many times have we heard that? from the likes of Bank of America and others too. In the next hour on Bloomberg Surveillance, we'll catch up with Linda Duessel of Federated, Hermes, Jeannette Lowe of Strategas, Ed Ludlow of Bloomberg, and Amanda Lynam of BlackRock. From New York City, your second hour of Bloomberg Surveillance up next.
The inflationary dynamics as well as the labour market are also signalling that there is a need or a necessity for the Fed to start policy easing.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives.
These inflation numbers seem to be weighing down on consumer confidence, and that's why you see some of the softening that we're seeing.
Once things start to unwind in a negative direction, it tends to keep going. And that's why, the risk here is significant.
Things are going to slow down in the second half, and we need to be ready for that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Your second hour of Bloomberg Surveillance starts right now. We'll talk about this repeatedly through the week. What a week we've got coming up for you. It starts with the economic data. It concludes on Friday with payrolls. That's the data. The week ahead for the central bank decisions, a triple header. You'll hear from the Bank of England, the Bank of Japan, the Federal Reserve, kicking things off on Wednesday. Look out for that. And then the earnings. Where'd you begin and where'd you end? The earnings for big tech. Microsoft tomorrow, Wednesday Meta, Thursday Apple, together with Amazon. Then you've got to wait a few weeks, wait a month. Nvidia, the big players reporting this week.
Arguably, the earnings will be most important this week. Just the tech giants account for about 20% of the S&P market cap. If you take a look at all of the earnings that we get, in addition to the likes of McDonald's and others, AMD, you end up with more than 30% of the S&P 500 at a time where big tech has led the way down. Can you get a reprieve with some big beats from the four that we get this week?
Show me the money. I think that's what Manus Cranny was talking about in the last couple of days off the back of some of these tech earnings. You always get a feel a few weeks deep into earnings season what investors are willing to reward and what they're going to punish. And I think we got a flavour of that in the last week with the likes of Alphabet.
There has been this theory that you can't spend enough money on the infrastructure around artificial intelligence, and the people who spend the most on CapEx will be rewarded the most. And that died last week. We saw Alphabet actually spend more than people previously expected on CapEx, and they were punished for it, which is sort of this question of, is this something that needs to be monetized now and in excess of what investors are expecting in order to continue a rally that has been historic over the past few years, but that has absolutely hit a speed bump?
And that's the earnings. For the Federal Reserve, I sense a little bit of calm. A lot more calm relative to where we were this time a week ago. Because going into last week, there was a sense of urgency from some people, including Bill Dudley, the former New York Fed president, who wrote that piece in Bloomberg Opinion. Let's go. Then the economic data came out and just settled things down again going into Wednesday. Do you think things are pretty settled down going into Wednesday?
There is a very small chance baked into the Fed funds futures market that the Fed does anything in terms of a rate move this week. Question's going to be whether they actually tee up a September rate cut, or do they just sort of give it the data dependence flavor that allows them to do it if the data cooperates? That, I guess, is sort of the big question. So that kind of took some of the steam out because you've got GDP, growing at 2.8% in the second quarter. And that really kind of threw some cold water on this idea that we were going into the tanker.
Jobless claims settled down a little bit as well. I think that was a key data point for us in the last week. We'll get another round of claims on Thursday, going into the big one on Friday. Payrolls Friday. Your economic data then, still ahead. The earnings, the central bank decisions, the scores into all of that look a little something like this. Equity futures on the S&P 500 firmer by 1/3%. In the bond market, yields are lower by 4 basis points now, 4.1550 on a 10-year. There's one thing we haven't talked about, but you'll hear a lot about it from a certain Lisa Abramowitz through the week. Quarterly refunding announcement from the Treasury.
Okay, I care about this because basically today they're going to give you an estimate of how much they're going to borrow, and then on Wednesday they'll give you a sense of what type of maturities they'll sell in at a time where you're talking about ATI, activist Treasury issuance. You're talking about the idea that this Treasury Department is trying to weight more heavily some of the issuance on the front end to avoid causing some sort of disruption in Treasury yields. For all those people who are falling asleep, this matters because the U.S. is selling record amounts of debt, and if they sell them in longer-term yields, you can imagine people will say, hey, can you pay us a little bit more to really buy all this stuff?
Just for the record, of course, I'm joking. I agree with you. A lot of people agree with you. It's an important story for later this week. We've talked a lot about a softer consumer. Certain companies just pushing back and saying, you know what, maybe we've reached a limit here. Here's another one potentially. McDonald's reporting just moments ago, Lisa, sales sliding for the first time since when?
2020.
Wow.
In the second quarter. And this comes at a time when you have same store sales falling 1%. They talk about how diners are pulling back. They are being more discretionary. We talked about the $5 meal and how they are extending it to try to attract diners in. Just to give you the number, the second quarter adjusted earnings per share came in at $2.97 versus the estimate of $3.07. There is a question of how much this is political, international. We'll dig into some of the numbers. At the same time, this is something we have seen elsewhere also, that in order to bring in some of those diners, these companies are having to create value meals of sorts that really give a value proposition that we haven't seen in quite a while.
It's a pretty telling quote from the CEO in a statement. The chain will remain focused on, quote, reliable, everyday value as diners become more discriminating with their spending. Cost-conscious consumer. Saw it from Pepsi, didn't we? Heard it from Delta and some of the airlines as well.
And you asked this question, at what point is this sort of a broader economic signal versus something that is specific to companies that have been raising their prices pretty dramatically over the past few years? How much is it a competitive edge of execution, and how much is it consumers falling off a cliff? We're walking that tightrope right now, where it seems to be on the edges. It's fine, but definitely showing that consumers are pushing back and rejecting high prices.
That wire's getting thinner and thinner. That stock is down by about 0.5% in early trading. Coming up this hour, we'll catch up with Linda Duessel of Federated Hermes as stocks gain ahead of a big week for tech earnings. Jeannette Lowe of Strategas with less than 100 days to go until the election. And Amanda Lynam of BlackRock as the Fed prepares to meet. We begin with our top story. Stocks attempting to bounce back, going into a busy week of earnings, central bank decisions and economic data. We'll get results from Microsoft, Meta, Apple and Amazon, plus interest rate decisions from the BOJ, the Fed and BOE. And we round out the week with the US payrolls report. Joining us now to discuss is Linda Duessel of Federated. Linda, I want to get straight into these earnings. Thank you very much for joining us. We've seen it from consumer company after consumer company, pushing back, just warning about maybe a softer consumer here. Linda, how much weight do you put on some of these warnings over the last couple of weeks?
Well, good morning, Jonathan, and thank you so much for having me today. Of course, we're very, very interested in what the consumer does, but, we've all been waiting to see them fall off a cliff, and retail sales do continue to surprise. Notwithstanding what McDonald's is saying today, it's the lower income cohort that we know ran out of the excess stimulus first, and it's really all about jobs. As long as we have jobs, job market is still tight. People, unemployment is going up, but it's still historically low. As long as we have jobs, we're going to go shopping. And I think that the consumer remains underestimated.
So is this a loss of pricing power or just poor execution? I'm struggling here, Linda. How are you framing things?
Well, it's definitely a loss of pricing power for sure. And it's been an easy road for a lot of companies in these last number of years. Yes, we've had historically high inflation, but with historically high inflation, if you can push that through, your top line looks good. And to the extent that we have lots of stimulus money, which we have had, just running out of it this year, first time this year now, then we would spend up for it. So that's why we at Federated Hermes are watching in the earnings season for what the profit margins and the outlook will be. And it's still fairly early on in the earnings season to make a decision on how that's going.
Given that the consumer is still strong in your belief, but is definitely price sensitive, and you definitely have seen a lack of pricing power from particularly companies that cater to some of the lower end, do you think that the outperformance that has been historic in small caps, in some of the other non-tech names, makes sense?
Well, small cap, was historically oversold. It had never been this inexpensive versus the S&P 500 since before the tech bubble burst. So if you look at the S&P 600, the PE ratio on a forward earnings basis is just about 17. That's 21 times for the S&P 500. They remain historically inexpensive. And what's interesting also about the small caps and where they start their move up this year, yes, it's been hard and quick, but they have never been historically so exposed in their trading to what was going on in the 10-year Treasury bond. So very, very exposed to what's been going on in interest rates. And you've just mentioned that we're at the low 4 handle on the 10-year right now. We at Federated Hermes think will be in a range of 4 to 4.5% for the time being in that area. That is a nice spot to stop and for the small caps to get a breath, especially small cap growth stocks.
There probably are people watching this who are throwing things at the screen saying, really, you're going to talk about small caps before big tech when you've got the likes of Microsoft and Apple and Amazon and Meta all reporting this week. A lot of people saying it's so important, especially because of the significant reaction last week from Alphabet and Tesla. How high is the bar for some of these tech giants to really exceed and restart a rally that has really sputtered out with a true correction?
Well, I guess the bar is pretty high when you consider that the top 10 names in recent weeks represented 37% of the weight of the S&P 500 on market cap. They also represented 31% of the earnings. So if you've never been that high, that's way higher than what it was before the tech bubble burst in 2000, which means that if any one of them falls off, disappoints a bit, so many of us own every one of these names. We've booked a lot of profits and we'll sell right away, notwithstanding the fact that they're probably still very, very well-heeled, lots of cash flow and probably excellent prospects going forward. That's just part of the volatility that we've been thinking you would see this summer anyway in the market. So it's just it's just a trigger that you pull and then you step back and you say, but now wait a minute. They are not historically as expensive, again, as we were back in 2000. And I was there when that bubble burst. It's not nearly like that. These companies are still extremely profitable. I think we'll have to remember that.
A big week ahead for earnings in corporate America. Linda, we have to leave it there. It's good to catch up. Linda Duessel there at Federated Hermes. I've got Mohammed Al-Aaron on one shoulder, just sort of whispering and now shouting, listen to the companies. So let's listen to some of the companies. Nestle, in the last week or so, there is value-seeking behaviour among consumers. Pepsi, a few weeks back. In the US, there is clearly a consumer that is more challenged. As Pepsi, this is McDonald's. The first slide in sales going back to 2020. They have this to say. They'll remain focused on reliable, everyday value as diners become more discriminating with their spending.
You asked the question, is this an execution question or is this a broad-based pullback by consumers? It's tricky to know the answer because on one hand, you have certain companies, Coca-Cola I can point to, that outperformed. You have certain airlines that have managed to do better than others, although albeit this is particularly difficult this time around. McDonald's in particular, there's also this issue of protests internationally, which they said is dragging on their earnings. So you start looking under the hood, and again, it's sort of, you hear that consumers are pushing back, but it's hard to extrapolate how far this will go.
That international story hit at Starbucks as well, right?
Yeah.
It's in a similar story from those two over the last few quarters. McDonald's is up by about 0.7%, just bouncing back from early losses in the last couple of minutes or so. Equity futures positive still by 0.4%. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. Another attack has occurred on France's infrastructure during the Olympic Games. This time, a number of fiber optic cables were cut overnight. The cables carry broadband services across France's southern and eastern regions. Orange, the Olympic telecom partner, said the connections into Paris and thus the Olympics were not affected. Just on Friday, coordinated fires on French rail lines had disrupted trains ahead of the opening ceremony. And President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal. It also calls for a constitutional amendment to ensure that former presidents can be tried for crimes committed while in office. The plan, though, faces a difficult path in Congress. Democrats have increasingly called for reforms to the court amid recent controversies, but passing those changes would require support from the GOP-controlled House. And Prada is set to open a flagship 8,000 square foot store in Hong Kong luxury mall. That, according to people familiar. Construction will begin soon, and the store is expected to open early next year. It will become Prada's first major new location in Hong Kong in years. Global luxury brands have been increasingly returning to Hong Kong's business district, attracted by property prices that are trading at much lower levels than the pre-pandemic levels. And that's your brief, John.
That's certainly a demonstration of confidence there. Danny, thank you. More from Danny later on this hour in about 30 minutes' time. Up next on the programme, less than 100 days to go.
That formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party. The vice presidential pick makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
We'll continue that conversation next. That's just around the corner. This is Bloomberg.
The Fed decides.
Who said summers were quiet? I don't remember the last quiet summer.
We're talking about the data not being as accurate during this time of year, an election that's haywire.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
Is the answer here, Jeff, that everything is just plain solid?
It's pretty solid, Tom. At some point, we got to call it a soft landing.
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern.
The focus has shifted to growth. The words of Mike Wilson of Morgan Stanley this morning, which is why for so many of you tuning in this morning, looking ahead to the week ahead, Lisa, there seems to be more interest in the earnings and the data than there is, say, the Federal Reserve on Wednesday.
It doesn't seem like the Fed's going to move. So other than that, how many times do you need to hear data dependence before you tune out? So this is the reason why people are looking at, hey, the data, which is going to be what will be the dependent upon notes for the Fed, as well as earnings, which are not only data points in their own right for the economics, but also dictating a massive part of the S&P based on earnings so far this week.
I think we're all excited and looking forward to just a week of conversations about a baby step towards a rate cut in September.
Right, that sounds fascinating.
Right, okay.
That's exactly how I wanted to really start my Monday.
Let's turn to the price action. We look like this. We're positive. The bounce back continues up by 0.4%. If you can call this a bounce, it's not much of one. Yield to lower by 3 or 4 basis points on a 10-year, 415.69. Under surveillance this morning, less than 100 days to go.
We've always talked about, double haters and how much people didn't want this race to happen. And all of a sudden there's a big alternative and a generational alternative. So far, that formula isn't filled out in the way that Trump needs in order to become president. He's still got splits in the party, I think. Number one. Number two, the vice presidential pick makes it much more difficult for him to actually appeal to independents in the way that I think Harris and a centrist VP pick is likely to.
So here's the latest coming into this week. Donald Trump and Kamala Harris hitting the campaign trail. Harris heading to Georgia tomorrow and Trump returning to Butler, Pennsylvania on Wednesday. The latest Wall Street Journal poll showing Harris and Trump neck and neck. Jeannette Lowe, Strategas, the bed company, joins us now for more. Jeannette, if the Democratic ticket was a stock, we'd call this a post-Biden relief rally. And we'd all be asking questions about the earnings releases in the quarters to come. And I'd be sitting here saying, what makes it durable? Tell me the fundamentals that supports this going forward from here. Can you point to what those fundamentals would be for Kamala Harris?
Well, I think the biggest thing that we've seen in this race is, that there was this absolutely lack of momentum or enthusiasm from most Americans about the two candidates they have. And so Biden getting out of the race, we were really starting to see his numbers go down since the debate. He was really starting to go impact down ballot races across the country. And that's really where we're starting to see the change with Kamala Harris at the top of the ticket. You're seeing the polling revert back to where it was pre-debate. So you have states like Pennsylvania, Wisconsin, and Michigan all within the margin of error. You have an enthusiasm, a gap closing, which you saw that in a poll over the weekend. And you're starting to really see people just engage. All of the calls that happened over, the past few days of people really getting engaged back into the campaign on the Democratic side. That's what's really changed. Obviously, it's just been 1 week, so we still have a lot more to see what actually happens. How does this messaging start to play out? If we do have a new debate in September between Trump and Harris, does that change the dynamic? Just because then you'll now actually see the policy differences between the two candidates, and that'll be important to see. But the momentum factor has really what's kind of changed the race here.
Jeannette, with Biden at the top of the ticket, we were talking almost exclusively as one path towards victory potentially, and that path was narrowing. And it was a rust belt, and you just alluded to it. Politico reporting over the weekend that maybe, and I think you might agree with this, we've reopened the conversation about Sunbelt states. Would you agree with that?
I would. We did see there was an Emerson poll that came out last week that showed Harris really closing the gap, particularly in Georgia. So that's important. So I think that's one of the states that she's really going to be looking to. We haven't seen a lot of polling coming out of North Carolina yet, but I know that that's another state that she would like to target. The Democrats have been targeting that for quite some time, a couple cycles, trying to see if they could flip that state from red to blue. So that she does actually open up the map. She has more options. If she were to win, if she were to lose one of the blue wall states, she could potentially win one of the Sun Belt states, and that could actually still help her get over the finish line.
Jeannette, how important will be her running mate to determine how much she can really gain in the Sun Belt, especially given that we now have a short list of about 3: Arizona Senator Mark Kelly, Pennsylvania Governor Josh Shapiro, and Minnesota Governor Tim Walz?
Right. So, I think one of the things that's interesting is that, in general, a vice presidential candidate does not do a lot for the presidential ticket. They can only usually add, but they can also subtract, but they don't usually add very much. In the past, it's been easier for a vice presidential candidate to actually win their state. That's been less true in more recent cycles. But I think Harris has some options here. She has been looking at more of the moderate candidates along the lines of Mark Kelly or Josh Shapiro. Tim Walz would be a little bit more progressive than the other two. So that would be a potential change if she's going to now have more of a progressive ticket than a progressive moderate ticket. But Arizona is one of the states where she's not doing particularly well based on current polling. So Mark Kelly can certainly help her with that. He also provides this national security, this defense component that she may be lacking, which can be very helpful to her. Josh Shapiro, I think, can help her deliver Pennsylvania. So if she's worried at all about getting that, that is a key attribute of him. And he can also help her in the other blue wall states like Michigan and Wisconsin. But I think that they're also thinking that Tim Walz is going to be a really good bulldog on this stage. That is something that you generally do look for in a vice president. And also he is from a state that Trump is targeting in Minnesota. And so that can help make sure that that state is shorn up, but then also help in other Midwestern states.
Jeannette, Libby Cantrell of PIMCO came on here and said we should all just have cocktails, go away for August, and come back in September and take a look at the polls. And then we can actually discuss who is in the front seat to really be the front leader heading into the election. Michael Azizis of Morgan Stanley over the weekend. The business cycle is likely to matter more to markets than the election cycle in the next few months. Jeannette, from a policy perspective, why is it so important to really watch the policies at a time where you said this election is still a referendum on the speed of deglobalization?
Yeah, so I think this is really important that, for one thing, that this race, now that we have Harris at the top of the ticket, it's moved from less of a referendum on Biden and his acuity to a choice about policy. And so we have less than 100 days to go. And Harris still kind of needs to figure out some of her policy positions. Is she going to continue the policies that she had as a 2019, 2020 candidate? Is she going to potentially moderate some of those positions? And this is going to be a race to the finish line. This is much less like what you would normally see in a U.S. election where we have 9 months of campaigning. So I do think that the next couple of weeks will be quite important. What happens at the DNC? What happens at that convention? What kind of policy proposals are you seeing? Are you seeing momentum? That is going to be a key component of this. But there is still vast differences between the two candidates on trade, on taxes, on regulation policy. And that's going to be really important for this election. That's what investors are really focused on. What does Trump versus Harris mean for trade? What do they mean for tax policy? And what do they mean for regulation? And I think that's where we really have to be kind of focused over the next couple of months. And you do start to see the elections start to price in. We do have a metric that shows that the market can actually predict about 80% of the time whether or not the incumbent party is going to win or the party out of power is going to win. And that starts around August 5th.
We should do this every time, just 100 days, just a sprint to the finish. Jeannette Lowe at Strategas. Jeannette, thank you. The most revealing thing took place going into the weekend. I've got to bring you this quote. It was reporting from ABC, and they said this. J.D. Vance said Americans without kids should be taxed at a higher rate in a 2021 interview. It just revealed how polarized this country is. We saw so many people react to this, reflexively exposing their own political bias. The people in news who thought it was news, and the political commentators who tailored their response to that quote based on the author and not on the content of it, blinded by their bias, so they weren't able to see that that actual policy already exists in this country. How ridiculous was that going into the weekend?
You do get tax credits if you have kids up to a certain income. There is this issue of how polarized people have become and whether people can actually look at policy or whether it ends up being this sort of social issues that are hot button. J.D. Vance has said a lot of things that are getting a lot of attention. I think that there's a certain Tom Keene who would agree with you that it should always be a 100-day sprint. I'm just saying that's something that a lot of people are saying.
Very much a TKS thing. But how can we have a conversation about policy when that's where things go in this country every single time?
That's exactly the reason why we're not talking about policy. And that's the reason why a lot of people who come on here who are markets participants, their eyes just kind of roll back in their heads.
Let's sort of ignore this and keep ignoring it. From a beautiful New York, good morning. The latest from Evercore this morning. Good morning. You'll hear a lot of this. We think the July FOMC meeting that concludes Wednesday will signal that the Fed is on track to cut soon and open the door to a cut in September, but will stop short of explicitly pre-signaling that rate decision at that following meeting because we have Jackson Hole in between. So there's another step there if they wanted to take it.
And people are expecting that to be really the time where they give a sense of what the policy shift is going to be and why they think it's so important to cut rates. Just to put this in perspective as to why we're not talking about the Fed meeting more, there is a 4% chance of a rate cut this Wednesday. There is more than a 100% chance of a rate cut in September. This is the de facto accepted position currently in markets.
And it's not about the first move. It's about the one after that, the one after that. What's the destination here? Where are we going? Do we have a decent understanding of what kind of economic regime that we're in right now?
And what's the backdrop in terms of, is it to fight off a slowdown or is it just sort of proactively to prolong this recovery, this expansionary cycle, which is the good cut or the bad cut? And the reason why the jobs data, as well as JOLTS and as well as a whole, and the ISM manufacturing will be really important.
Couldn't agree more. Just to echo that, the difference between the wrong kind of rate cuts and the right kind of rate cuts, payrolls Friday. Look for payrolls this Friday. The scores going into all of that look a little something like this. Equity futures on the S&P 500 up by 0.4%. On the Nasdaq 100 up by 0.7%. The outperformance on the Russell over the last few weeks continues, up by 0.75% on the Russell 2000 this morning. Lots of discussions about earnings. I think we have to talk about McDonald's. The first sales slide, Lisa, in 4 years. Notable for that chain.
Especially as they talk about consumers that are being much more discretionary and the need for reliable everyday value. This came from their CEO at a time where they're extending their $5 value meal. That is one aspect that's been bringing diners back to the chain. We've heard this from a lot of companies. Understanding the broader significance, the trajectory of that weakening consumer, harder to understand.
The companies are saying things are slowing down. We're losing pricing power. You've got to ask yourself, where does the top line growth come from? Where's the margin expansion come from? They're going to cut costs? Does that mean pulling back on jobs? Will that start to show up in claims? Will that start to show up in the economic data we see on every first Friday of every month? Let's turn to the bond market. The 2-year last week rallying. Yields lower by double digits, down 12 basis points, down another single basis point this morning. 436.68. We're down 3 or 4, Lisa, on the 10-year, 415.89.
And this comes ahead of a really big week. And we mentioned this before because not only do we get the economic data and the Fed decision, but we also get what debt the Treasury is going to sell at a time when a lot of people said that this will be the technical factor that really underpins how much of a premium there is. Look, I think that there is a sentiment of sort of buy the rumor, sell the news. It's sort of buying duration ahead of whatever could potentially happen because the Fed is biased toward cutting rates, so you can't get burned too badly. That's sort of the feeling right now in markets, and you can kind of sense that as things sort of coalesce around some rate cuts starting in September.
I think last summer's quarterly refunding announcement was part of the trigger, part of the catalyst for the sell-off that we saw in debt going through to October.
Thank you. I like this. This is actually giving a sense of why this is important. It's true. This is sort of giving people a sense of the real world consequence of record amounts of borrowing by the U.S. government. Is this week going to be the trigger? We shall see.
I'm here to support you.
That was really kind.
That's why I exist. Marvin Lowe was on a programme, by the way, in the last hour. We've talked about this a few times, but if you're just tuning in, it's worth pointing out again. He thinks the supply dynamics will reassert themselves as we go deeper into 2025. And his call on the 10-year might surprise you. He's not looking for the 3s. He's not looking for the 4s. He's looking at a return to the 5s 5.25% on a 10-year yield next year.
And he said that, potentially they could not be the haven assets that they have been in the past. This is pretty dramatic, and that would really cause a reassessment of equity valuations as well. He's not in consensus, but he's not alone either. We've heard this from others as well.
Might upset some of those trades looking for a stronger Japanese yen. Certainly worked over the last few weeks. 4 weeks of yen strength for the first time in 2024. Dollar yen's down to about 153.77. The path to 150 seemingly on the cards if we get a strong tilt towards a rate hike. Lisa from the BOJ later this week.
Right now, the market's baking in about 2 rate hikes from the Bank of Japan this year. Unclear whether they are going to hike into September. That's kind of the base case, although not fully priced. The big issue for them is they're facing weakness. They're facing actually a sense that the consumer is getting exhausted by some of the increase in inflation. So how do they toggle between a currency that's depending on them normalizing and a consumer that may be running out of steam?
Dollar yen right now, unchanged, 153.76. Under surveillance this morning, some top stories for you. Donald Trump embracing the crypto world. Trump telling a Bitcoin conference he will fire SEC chair Gary Gensler and replace him with someone who, quote, loves cryptocurrency if he's re-elected. Trump returning to Butler, Pennsylvania this Wednesday, a little over 2 weeks since an attempt on his life at a rally there. Kamala Harris will be heading to Georgia. Where did this all come from? What's it all about?
Lots of money in the crypto world.
Campaign donations.
I mean, that's what a lot of people are saying. I'm just looking at some of the people who are now supporting him. It includes, of course, Elon Musk, as well as Tyler and Cameron Winklevoss. He was talking about how they look like models, but they actually have brains. And they also have venture capitalists Mark Anderson and Ben Horowitz. Those are some of the people who are starting to back him as he talks about tech prowess and as he talks about supporting the crypto world.
Is he implying that people who look like models don't often have brains? Is that where he's going with
I don't know what
it's hardly controversial stuff.
Okay, thank you. Is that really what you? Is that how you'd like to?
That's my takeaway.
Thank you.
Let's turn to this story.
It's just,
I can
classic.
I can move on. Let's get to political tensions flaring in Venezuela. As President, this is a hard turn. President Nicolás Maduro claims an electoral victory with just over 51% of votes compared to 44% for his rival Edmundo González. The opposition party members are disputing Maduro's win, saying they've accessed 40% of the tabulated votes, showing González winning 70% of the votes so far. So shock horror, dictator says he's won election. Now comes the challenge.
Yeah, especially at a time where Secretary of State Tony Blinken came from Washington saying serious concerns that the results announced do not reflect the will of the Venezuelan people. The international community is watching this very closely and will respond accordingly. What I find interesting, actually, is that the U.S. has actually been more friendly toward Venezuela recently than they had in the past, in part because of oil and gas. So, I mean, it just sort of is interesting at this moment when elections very much matter and are reshaping a lot of the diplomatic venues.
In a big, big way. Let's turn to the earnings. I know you want to do this anyway and sort of move on from the politics. Big week coming up with 4 of the Mag 7 reporting. Microsoft kicking things off tomorrow, followed by Meta, Apple, Amazon, Wednesday and Thursday. And now Bloomberg reporting this about Apple. Apple's upcoming AI upgrades will be delayed. Bloomberg's Ed Ludlow joins us now for more. Ed, good morning.
Good morning. Where do you want to start?
On the East Coast. I think we have to start with that Apple story, front and center for us. Are we saying that a new phone comes out in September, but it lacks the goodies?
It's really important to remember that the big run-up in Apple shares year to date or more recent performance was predicated on the hopes that this is it. We're going to finally get Apple's offering for generative AI. It's called Apple Intelligence. What Mark Gurman reported is basically chronology. So in September, you're going to get the new generation iPhone, 16, 16 Pro. And when they announced Apple Intelligence, they said that's when we'll give it to you with the new generation launch of that phone of iOS 18. What Mark is reporting is that they're going to kind of stagger it. They're going to say, okay, well, you'll get the new iPhone, then you'll get the new OS, iOS 18, and then several weeks after that, we're talking a matter of weeks, it's a delay of weeks, we will make this available through an update.
So tough question, why do I want the 16?
It's always a tough question. It's a good question. You have to decide how much in any given upgrade cycle you care about, I guess, incremental improvement in speed, processing power. I got an iPhone 15 Pro. It's pretty fast, fine for me. And camera. You know, that's the main point. You go to the root of the problem and the question. We're waiting on the software, ironically, this time around. And if you're impatient and you're an investor that's nervous about the Apple story in AI, you've got to wait a few weeks longer than expected.
Not to be skeptical, but isn't part of the whole upgrade? Thank you. I appreciate that. Therapy on a Monday. You know, how much of people buying the new iPhone is because it looks cool? Because you can show the gadgets and the different types of attributes to your friends. How much can AI really add on that front at this point, given where it is?
It's a really interesting story, and it puts to the question of how much faith you put into third-party data. And I say that because when Apple reports earnings, usually the opposite of what the third-party data has proved true. That said, in the first quarter of this year, there was a lot of evidence that the Chinese consumer, for example, was very satisfied with the iPhone 15 generation. You know, in surveys and the shipment data, it would indicate that they bought it, and that would be it for quite a long period of time. You wouldn't come back and buy annually a new generation of iPhone. The other interesting point of difference is that Apple Intelligence is going to be available from, I believe, the 15 hardware generation anyway, meaning you don't have to absolutely buy the 16 to get to it. Your existing handset's fine. It's all strategy from Apple, and I think that most people would say they're satisfied. You don't spend handset or hardware money to get AI tools. A lot of people in the consumer use case are going with what's free. It's a beautiful part of the Microsoft story, right? Microsoft's been really good for a really long time, even before I was born, at selling software that you could otherwise just get for free. And that's where we are right now in how humans use generative AI. I like using it, but I'm not willing to spend. And I think that's going to be a big story for the rest of the year.
You mentioned Microsoft.
Yeah.
We're going to hear from Apple this week. Maybe they'll give some more guidance on this particular front. We're also going to hear from Microsoft. We're going to hear from Meta. We're going to hear from Amazon. We've been asking this all morning. How high is the bar for them at this point, given how punished Alphabet was? Tesla's is a bit of a different story, but Alphabet for simply investing more than people had expected.
Yeah, the story across all four of the names that report this week is very simple, that no one's yet able to say clearly for every dollar you've put in, how many dollars come out. And they all have a different way of putting it. So last quarter, Microsoft said they had 31% top-line growth in cloud, and 7% of that growth came from AI sales. It's somewhat tangible, but for the market, they basically say, we expect you to invest, but we reserve the right to be disappointed if you can't give us something we understand. And that was really the story of Google last week, right? They said that year to date, they had made billions of dollars from generative AI and AI infrastructure. That's another way of saying we made money basically for the business of cloud that does both of those things, but we're not going to quantify for you specifically how much came from the generative AI side. In other words, how many dollars came out for the infrastructure investment they'd made, while infrastructure came in higher than the street was expecting.
If you could have any of the earnings right now, which would it be?
So the reason Alphabet was so good that it went first is that it told us everything about everything. They do cloud, but search is their core business, right? And so the street looked at it and went, hold on, I thought this was about AI, and you're telling me the thing you've always done is still your most important thing. That makes Amazon really interesting for me. AWS has a revenue run rate of $100 billion and a revenue run rate of billions in generative AI, but increasingly advertising has become important for them, and we get a gauge on the consumer. You kind of get everything, and you probably don't get that with Microsoft. Microsoft sells software. They've always sold software. They're quite good at it. You don't really learn that much from it as you might learn from Amazon.
Ed, it's good to see you. You're here all week?
I'm here all week. Thank you for having me.
Looking forward to covering the stories with you. Ed Ludlow there from the West Coast, now on the East Coast for the next week or so to break down some of these earnings. Equity futures right now on the S&P positive by about 0.5% with an update on stories elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Speaking of earnings, McDonald's shares up slightly, 0.6% in the pre-market. Sales declined for them for the first time since 2020. From international to U.S. locations, each of McDonald's geographic footprints saw sales decline for an overall drop of 1%. The estimate was for a 0.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to try to lure customers back in. McDonald's latest is a $5 meal deal that it launched last month. And Chinese tech company Xiaomi has purchased a plot of land in Beijing for over $100 million to expand electric car production. The move follows the early success of its debut sedan. Xiaomi first entered the auto sector in March and has already delivered 30,000 vehicles so far. The company's on track to reach its initial goal of 100,000 cars by November. The company is perhaps better known for its smartphones, but it's also aiming to bring an SUV similar to a Tesla Model Y to market as early as next year. Disney's Deadpool and Wolverine has shattered box office records this weekend, bringing in $205 million. The buddy superhero film scored the best ever opening for an R-rated film, with more than twice the ticket sales of 2019's Joker during its first opening weekend. The latest entry in the ever-expanding Marvel Cinematic Universe continues Disney's hot streak this summer after Pixar's Inside Out 2 grossed almost $1.5 billion since its June release. And that's your brief. John.
Disney needed some good news. That's some good news. Thank you very much, Danny. Up next on the program, too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Get a move on. We've heard that on repeat, haven't we, over the last couple of weeks? They're not going to get a move on, based on what they've told us going into Wednesday. That debate is up next from New York City. You're watching Bloomberg Surveillance. Equities right now on the S&P. Positive by 0.4%. A little bit of a bounce continues. Yields lower by 3 or 4 basis points. The 10-year 4.1569. Under surveillance this morning. Too little, too late.
I think the Fed should have been cutting earlier this year. Reason being that they've achieved their objectives. The counter is, well, nothing's going wrong. Well, really, you're going to wait till something goes wrong before you start cutting rates? Isn't that too late? The labor market's feeling a little squishy here, and again, why take a chance? Mission accomplished. You've achieved your goals. Let's get going.
Here's the latest. The Fed expected to set the stage for a September rate cut when it meets this week. But some market participants are wondering if the central bank is behind the curve. Amanda Lynam of BlackRock is in the September camp, and she joins us now for more. So, Amanda, we've got Moody's saying get a move on. We've got Bill Dudley saying get a move on. Mohamed El-Erian saying get a move on. What's the excuse to wait?
Good morning. Thank you for having me. I don't think there is a strong sense of urgency for the Fed to cut, given where growth is. But at the same time, we are seeing loosening in the labor market, weakening in the consumer. In addition to the earnings that you've been citing this morning, you have the Philadelphia Fed credit card data that shows consumer delinquencies on credit cards at a 12-year high. So that bifurcated low end of the consumer really is feeling the pain. And so I do think the Fed's been communicating this kind of pending rate cut for a long time. Inflation has been moving in the right direction really since April. So we certainly see the case for them to kind of tee up a rate cut in the July kind of commentary and then move forward with it in September. I think the question, though, really is what is the depth of this rate cutting cycle? So how far do they go? How much relief, for example, does that give consumers and corporate borrowers? And then also, again, the drivers behind this rate cutting cycle are really important. Are they cutting urgently in response to deteriorating growth and deterioration in the labor market? Or is it really just kind of normalizing monetary policy?
This is a difficult question to answer, but just explore it with us. Where would you look for in credit to sort of discount some of these issues that might be on the horizon? Because credit spreads, Lisa and I have been going back and forth on this for the last couple of weeks. They're super tight. They say there's nothing to see here. There's no growth scale whatsoever. Is that right?
So there are some pockets of vulnerability. High yield spreads, 306. Well below the post-financial crisis average. But there, in addition to the kind of well-telegraphed themes that many talk about, there's one point that I think is really important and kind of explains some of this resilience in credit spreads, and it's unique to the cycle. It's that companies are staying private for longer. They're staying in that kind of private lending ecosystem for longer. So by the time that they get to the high-yield market, they're larger, more diversified companies, and I think that is a defining feature of this cycle. But to your point, Jonathan, triple Cs are showing this. They've not kept pace with the overall rally in the broader high yield market in terms of spreads. And even within triple Cs, there's a lot of bifurcation. There's some triple Cs that trade at 700 and some triple Cs that we refer to kind of as kind of almost broken capital structures, and they trade much wider than that.
I want to dive into what you just said, which is that companies are staying private for longer. And it raises this issue. Are you going to see the distress in a more pronounced way first in the private credit sphere before you see any disruption in the public markets?
It's a great question. I think the important offset is that the underwriting process in the private markets and kind of the structuring is very different than in the liquid market. So these are exposures that are held on kind of one lender or a few lenders' balance sheets. They're held in size. They're held for the maturity of the loan. I do think it's going to be difficult for new entrants in private credit that don't have kind of incumbent business models and perhaps workout expertise. So I don't think this is a rising tide lifts all boats, that all private credit lenders will be insulated. But the important thing is the growth backdrop supportive? Our view, and this is true for both liquid and private credit, is that you need either trend or above trend growth as a prerequisite for the ongoing resilience that we've seen. So that is really what we're looking for. We're not expecting material near-term interest rate relief. And so given that, you need the growth backdrop to kind of play along to keep profits and margins elevated. And they're already getting squeezed. So that's what we're watching. But just to circle back to the high yield spread comment, I think it shows that this cycle is so unique because we often look to kind of the 90s and the early 2000s. The credit markets are completely different. I think the best analogy you could make in terms of valuations and credit is mid-2021, where that was kind of the local peak for spreads, both in IG and high yield. But keep in mind that yields were much lower then. So actually, the yield-based buying that's happening today is a strong tailwind for spreads. And we're even wider than those mid-2021 levels today. And in 2021, we didn't have the yield support. So I think there's a significant opportunity cost for being materially underweight credit at the moment.
Are you saying that the credit can no longer be the canary in the coal mine? That essentially you could see a rolling over in some of the economic activity without necessarily commensurate credit spread widening just because of the good balance sheet situation?
I think the case for broad-based deterioration in corporate credit is a bit difficult. I think the bar for that is very high. Our kind of theme for the past few quarters actually has been dispersion, but not widespread market disruption. So I think really the most likely outcome is that you see these kind of canary in the coal mines in certain issuers, certain sectors, parts of the high yield market, parts of the private credit market, parts of the leveraged loan market. But broad-based deterioration, I think, is difficult because the cycle is just so unique. You've got technical tailwinds from most of the supply being refinancing related, so not a lot of new money, yield-based buying, a third viable option of funding in private credit, and 2.8% GDP growth. So even if we slow from here, we're probably still at trend. I think that's really the key to watch, is the growth back up.
I just want to understand if this is what you're saying. What I hear is that spreads can remain tight for longer than you think because the all-yield opportunity is just so great right now compared to where we've been previously.
Yeah, and not exclusively for that reason, but coupled with the fact that corporates entered this period from a pretty solid balance sheet position. And then, of course, you have this kind of other viable funding market in the private markets. And then also the technicals have been supportive in terms of supply. So yes, there's been a lot of supply in high yield and leveraged loans, but it's actually been skewed towards refinancing. The other thing that gives me comfort is corporates are now chipping away at late 2025, early 2026 maturities. So when you think about kind of high yield possibly widening or IG even widening, you kind of go to what's the catalyst. I think it's unlikely to be a payment catalyst because the balance sheets are in such.
So that maturity wall scare of next year survive until 25. We put that story to bed?
I think, yeah. I mean, I don't know if it's to bed for every single corporate because there are some, I would say, again, CCC, really kind of lower quality issuers that are struggling in some instances to kind of shore up and get into a sustainable capital structure. But corporates have made great progress on it, and I think appropriately so. They've capitalized on the strong tone.
And looking right now at the all-in yield for high-yield bonds, it's 7.6%. It's close to what it was back in mid-2022. So it's about the lowest levels going back 2 years. If the Fed cuts rates, does that actually make financial conditions easier? Does that actually lead to lower borrowing costs for companies from here? Or are we kind of stuck here for a while, one way or another, that spreads can compensate for any decline in yields?
If the Fed cuts rates, I think what it could do is bring some of that cash out of money market funds and kind of deploy it into longer term maturities. For corporates, I think they've been appropriately issuing irrespective of the rate environment. So if we get a 25 or 50 basis point cut this year, I don't think it's game changing for high yield corporates. I don't think they suddenly rush to issue. And in fact, the commentary from some of the large banks with debt capital market syndicate operations has actually said that the activity in the first and second second quarter was a pull forward from later this year, possibly to get ahead of event risk. So I actually think the calculus for corporates when they're issuing has been less about the rate environment and more about how can I shore up my balance sheet, how can I be proactive, and I think that's appropriate.
Amanda, as always, just fantastic breakdown. It's good to see you. Amanda Lynam there of BlackRock, just on the resilience of credit and the reasons for that resilience.
And this has been the reason that people have pointed to why they're not nervous that there's going to be some sort of big sell-off or some big recession. They say, look how tight credit spreads are. Well, maybe credit spreads aren't going to respond as quickly. And this is the problem, is that maybe specific credit spreads will respond, but not broad-based, because there are lots of different economies that are moving at different cycles post-pandemic.
It's not the credit market of 15, 20 years ago. I think it's fair to say, right?
It's not your grandmother's credit market.
Is that how old your grandmother is? 15, 20 years older than you. Come on.
Yeah,
Grandma,
okay. Good. No, I'm just saying.
Grandma.
All right, no, I'm just saying.
307.
I know,
you know,
okay, but, back in...
You're aging people, okay? They were around for that. Remember that.
I was too.
Same here.
Okay.
Equity futures right now.
Thank
on the
you.
S&P, firmer by 0.4%.
How about those markets?
How about that market? In the next hour on Bloomberg Surveillance, a younger audience as everyone tunes out. Coming up, Kevin Gordon of Charles Schwab, Arun Sundaram of CFRA, James Camp of Eagle Asset Management, Zach Griffiths of CreditSights. That's up next. This is Bloomberg.
The market is not oversold yet. We think that this correction continues.
This is the problem that we're seeing. We don't have a consistent message coming from the earnings season. That's what's causing some of this volatility.
While there could be some stumbling, we are maintaining our overweight recommendation on tech.
There's likely this disconnect that's building between the earnings expectations and what's happening in the economy.
Ultimately, I think, the fundamentals matter. And I think the fundamentals sort of support this rotation.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning. Good morning. For our audience worldwide, the third hour of Bloomberg Surveillance begins right now with a massive focus this week, once again, on the US consumer. Just some of the highlights, some of the quotes we've had from corporate America over the last few weeks. From Nestle, there is value-seeking behavior among consumers. From Pepsi, in the United States, there is clearly a consumer that is more challenged. And from McDonald's this morning, they will focus on, Lisa, reliable, everyday value because diners have become more discriminating.
It's coming from every sector. It's coming from the airlines. We heard it from Stellantis' CEO last week that the goal is on cutting prices, on being competitive even with China, which they said had a 30% pricing advantage over them. Or cost advantage, I should say. Here's the issue. At what point is this just a tempering of the massive run-up in prices and, frankly, pricing power that we've seen from some of these companies versus a real beginning of a softening cycle led by the consumer?
Which is why Mohamed Al-Arian says cut interest rates this week. It's why Mark Zandi of Moody's says why take the risk, make a move this week. It's why Bill Dudley, the former New York Fed president, says get a move on. Then you separate those calls and you look at the economic data and you look at jobless claims and where the labour market still is, and you ask yourself, is there a rush?
Especially at a time when you're not necessarily seeing broad-based layoffs in response to shrinking profit margins that we were talking about. It's unclear because, as one person, as Mark Zandi was saying, do you really want to wait till something breaks? Do you really want to wait till we see the pain, at which point it's going to be too late? There is an added point here, and this is what I very much want to hear from the Fed chair this week. How much are they trying to loosen the pressure for the lowest end consumers, which are actually showing some real strains and will be arguably affected by a lower borrowing cost on the front end, most directly considering that companies have already locked in pricing and won't necessarily feel it in the same sort of manner. So those are some of the considerations I expect to hear.
Which is why for this story specifically this week, I'm not so much interested in the Federal Reserve decision, the BOJ, the Bank of England. It's all important. But there are other things that I think are more important for this conversation exclusively, and it's payrolls on Friday. And we've gone over this repeatedly. Payrolls on Friday is going to be the difference between the right kind of cuts and the wrong kind of interest rate cuts. If you're cutting interest rates because jobs are okay and inflation's come down enough, good stuff. If you're cutting interest rates because unemployment's getting away from you, that's the wrong kind of interest rate cut this September. And that's going to be the difference going forward from here. Every first Friday of the month for the next several months, where's payrolls? Where's unemployment?
And when you say the difference, it really determines whether rate cuts are going to spur a risk rally or whether it will spur a risk sell-off. That is the distinction here, because if you get rate cuts in response to real weakness, that will signal there is a problem. These stocks, these corporate bonds aren't going to do as well and people will sell. If it's just to simply prolong the expansion, well, let's go. Back to the party.
Too little, too late, or back to the party? That's the conversation this morning and through the rest of this week, I guess. Equity futures right now on the S&P 500 look like this, or the rest of this year, who knows? We're up by 0.4% on the S&P. We're down 4 basis points on a 10-year. The rally in treasuries continues. Double-digit decline at the front end of the curve last week. The 2-year down 12 basis points. Just keep chipping away, shaving away at that yield across the curve. The 10-year down to 4.15. And an announcement on supply, quarterly funding, later this week as well.
Yeah, people are expecting them to come out. Today, they're going to give an estimate of how much they're going to borrow. And then on Wednesday, they'll break it down in terms of which denominations. And this comes at a time where, John, you were talking about activist Treasury issuance. If the Treasury starts to issue more at the long end of the curve, how much does that actually prop up prices or prop up yields, lower, suppress prices on the long end, leading to a bear steepening? This idea that the long end is seeing a sell-off in response to supply issues, not because of a dramatic amount of growth, and front end really getting a rally.
Peter Schiff Academy saying supply would reassert itself. Marvin Lowe of State Street early this morning saying the same thing. Marvin Lowe, a 5-handle again on a 10-year. That's his call for next year.
That's pretty bold. Can you imagine what stocks would do if there was really a 5.25% 10-year yield?
Tell me where the economy is, and I'll tell you what stocks would do.
All right, Janet Yellen.
If we've got unemployment closer to 5 and yields are 2, we've got a big problem.
Yeah.
A big problem. Coming up this hour, we'll catch up with Kevin Gordon at Charles Schwab on why he says the great rotation will continue. No one's ever called me Janet Yellen. Arun Sundaram, that was delayed, I know. We'll catch up with Arun Sundaram of CFRA as consumers start to pull back. And Zach Griffiths of CreditSights on why the market is pricing in a dovish hold for this week's Fed meeting. I'm sorry, Janet. We begin with a big issue, the cusp of correction, a turbulent rotation out of big tech, dragging the Nasdaq down 8% in just over 2 weeks. Kevin Gordon of Charles Schwab seeing that rotation continuing, saying this: the normalization process will continue to pull up the laggards, but it won't be smooth. Much of this is now starting to take place given the recent snapback in small caps. Small caps are really just doing what they were supposed to do more than a year ago. I'm pleased to welcome Kevin to the program right now. Kevin, good morning.
Morning, guys.
It's great to see you, sir. Let's start with this. Just your framework for thinking about things at the moment. Rolling recessions, rolling recoveries. Is that how you still view things?
Yeah, it's still how we view things. And, you know, for the most part, it's kind of kept up with how the economy has evolved this year. I mean, it's been a choppier process, though, for the recovery part. So when you think about areas of the economy that went through their own recessions, manufacturing, housing-related consumer goods, in that 2022 to 2023 period, those have now started to enter recoveries, but it's been choppy. So manufacturing's been choppy because of the turn lower in some of the ISM and some of the regional Fed data. Of course, the consumer's been under, you know, still some pressures you've all been talking about today. And then now you're starting to see it morph a little bit into services. And this is now the point where I think we really start to see, you know, more meat on the bones as to how much the services hit is really going to take down the broader economy, or if you can get that nice kind of roll through on the manufacturing side, and it's just a softening in services, and then you kind of keep everything afloat. So to the normalization part on the market's part, I think that, in our view, is still that you've got these laggards that are more cyclical in nature, that are smaller in nature, that really struggled as the cyclical parts of the economy, you know, struggled. And then now they probably have more runway to at least normalize or catch up a little bit.
So let's talk about the service industry first. Surprise for us all, I think, was the airlines. Yeah. We came into this quarter, we all went to the airport busy, went on a plane packed, and then Delta, United, American all came out and said it's not as good as you think it is. What did you make of all the commentary we've heard from the service industry?
You know, I think it's tough because now you're at a point for especially the labor market where things have started to soften. You've seen not only on the demand side, you know, things start to cool, but that's morphed into now just overall aggregate income growth cooling as well. And it's not this Armageddon scenario where you have to automatically start comparing to prior recessions like the global financial crisis or even to some extent the tech bust, which in GDP terms or, you know, labor terms was not that, you know, cataclysmic. But I do think that some of the discretionary spending and the choices that consumers are starting to make and being a little bit more selective and decisive on where they put their money, that's become, you know, a bigger part of the story. But I think we also have to keep in mind, in many ways, we've been calling this year sort of a tale of two markets, but there's also been a tale of two economies, especially on the consumer side. You look at inflation within CPI for non-discretionary versus discretionary items. The non-discretionary items, that annual inflation rate is still running in the 5 to 6% range. But if you look at the discretionary items, it's basically flat. So I think because that you're now starting to see that income growth slow and consumers are having a little bit of a harder time, especially down the income spectrum, deciding where they're going to put their money, even if they're still fully employed, it's just a choice that they're making and being more selective.
You have a pretty contrarian call. You said that if we look at certain traditional metrics, we're actually in a recession.
Well, it's if something like the unemployment rate itself, one of the, I think, cycles you could look back to, not saying that this is a repeat by any means, but what's interesting to me and one of the most fascinating recessions to study is the one that was from 1973 to 75. For the first 9 months of that recession, payrolls were positive. Payroll growth was actually positive. It was decelerating, but you were still adding jobs, even as the unemployment rate went up from mid-4 to mid-5%. You didn't start to get that waterfall in payrolls until the very end of that recession. So it kind of speaks to the fact that, we have seen a move up in the unemployment rate this time. It's been more driven by, an expanding labor supply, although that's typically what happens, even in a recession. But if you're going into one, or if we're going into one that's a little bit more traditional in nature, then you're by definition already in it. Because that's what, the peak is when the NBER goes back and dates the start of the recession. But again, I don't think it needs to be this, sort of bombastic, we're going into an epic recession. You've had some that are a little bit more mild in nature. You've had some that are a little bit more severe. The ultimate trouble with this is that the sample size is just not that large.
I like how you try to talk down the analogy of suddenly heading into a 1970s style recession, because a lot of people will start extrapolating out, stagflation, and it becomes hyperinflation, and all of a sudden, how do we get out of there? At this point, is the bigger risk the deceleration on the labor market, or is it a stickiness in inflation that creates a sort of, something that rhymes with 1970s?
Yeah, I think the risk, and rightly so, and the Fed has been pointing to this, and all the Fed speak has been pointing to this, is probably that the labor market's becoming more of the issue that they want to be able to, at least get ahead of, even if it's a couple of rate cuts and hopes to get there. I think that they're trying to signal us in that way. And, this is the part where you try to figure out and suss out what's the actual inflation rate that they become more comfortable with. And they're not going to, Powell has said it many times, they're not going to wait to get to 2% year over year on PCE or core PCE until, it's mission accomplished. But, the labor market becomes more of, I think, a dominant piece of the puzzle at this point. And it's a very different scenario, even just 6 months ago, when you had all of these inflation metrics, whether you annualize them on a 3 or a 6 month basis, that were showing we were at 2%, but the labor market was still relatively tight. Now you're in a position or at a point where the labor market's just not as tight. So I think they have a little bit more room to work with there.
The destination we're going towards, I'm just thinking of lower interest rates potentially, lower growth maybe, and higher unemployment rate. It doesn't scream cyclical, small caps and banks. It kind of says, shouldn't we be buying tech?
Yeah, I think that's one of the reasons where, we think that this rotation, if you want to call it the Great Rotation or the Great Reaction, whatever you want to label it, I think it has room, but probably more for the profitable and high quality parts of the market, because when you look at that initial thrust after, post-June CPI report, it was kind of an everything rally for an index like the Russell 2000. Now that has started to split a lot more, where even if you go over the past year and you use just one criterion of profitability, whether companies have profits or not, the profitable group is up by almost 20%. The non-profitable group is basically flat. So you have seen, on the part of the market and investors, you have seen more selectiveness when it comes to that index. And I think that will probably continue. But again, I think it's more of a normalization, because we have to keep in mind the Russell 2000 is still not back at its November 2021 high. So if this was the case where we were just ripping from those highs and you were at a same stage or in a similar state as the S&P 500, then I think it would be a little bit more worrisome. But right now it seems a little bit more reactionary. And again, to your point, staring down the barrel of a labor market that's still softening and GDP growth that's still cooling doesn't make a whole lot of sense to me as to why small caps would automatically just rip the baton from large caps.
Kevin, this was awesome. And I have to say, this line in your note was music to Bramo's ears. Life is simpler when you keep politics out of investing. Did you like that too?
I loved that line. He wrote that several times, which I really relate to.
Shows you how I feel about that.
Yeah. I think you were basically like, please do not ask me about it, because I will not answer.
Talk about it.
You're in good company. We'll let it go. Kevin, it's good to see you. Fantastic.
Thanks,
Thank you, sir. Kevin Gordon there of Schwab. Let's give an update on stories elsewhere this morning with your Bloomberg brief. Let's get across to Danny Berger. Hey, Danny.
Hey, John. Israel attacked Hezbollah targets on Sunday and threatened further retaliation for a rocket strike that killed 12 children. Israel also signaled openness to a proposed Gaza truce that could calm the second and more combustible front with Lebanon. Prime Minister Benjamin Netanyahu returned early from a U.S. visit where he was seeking to drum up support. Netanyahu's office said the prime minister held back-to-back consultations with military chiefs and the security cabinet. President Biden will call for term limits and ethic rules for Supreme Court justices later today. It's part of a sweeping new proposal, which also calls for constitutional amendments to ensure that former presidents can be tried for crimes committed while in office. Democrats have increasingly called for reforms to the court amid recent controversies. However, passing the plan faces a difficult path, requiring support from the GOP-controlled House. And it was an eventful opening weekend at the Paris Olympics. Simone Biles and Suni Lee stole the show for U.S. gymnastics, both qualifying for the all-around final. Kevin Durant powered USA basketball to win over Serbia, and the U.S. secured its first gold with the men's 4x100-meter freestyle relay. The U.S. is leading the overall medal count with 12, 3 of them are gold. China has 5 gold medals and 9 overall. And that's your brief. John.
Danny, thank you. I like my Olympic medal table. Population adjusted. Australia always punching above its weight. You seen that?
Especially in swimming.
It's amazing.
They're incredible. Well, it's like a good build.
When you go on vacation, notice who's up first. It's always the Australians. You ever noticed this? They've already done a hike by the time you've sat down for breakfast.
It's true. They tend to be very
outdoorsy people.
I feel like we're going to get in trouble for this.
Super fit. No, it's a real thing.
Okay, I know, but it's true.
Do not deny me my real life experience, all right?
Please, I won't.
Okay, it's my lived experience of my vacations. Australians are up early, they're fit. That's what I see all the time.
Congratulations, if
and
you're
the Olympic
Australian.
table backs that up. Up next on a programme, the morning calls. Plus, Arun Sundaram of CFRA as consumers pull back on post-pandemic revenge spending. That conversation up next from New York. This is Bloomberg. So much love now for Australia for good reason. Equity futures right now on the S&P look like this. We'll get back to the markets. We're positive by 0.4% on the S&P 500. Let's get you some morning calls. First up, Morgan Stanley naming Tesla as its new top pick within the US auto sector. The analyst maintaining an overweight rating and street-high 310 price target, citing cost cuts and restructuring that have helped to restrict the downside to Tesla's EV business. That stock is up by 1.7%. Your next call coming from Citi, raising its price target on 3M to 133 and keeping a neutral rating. The analyst saying upside to second quarter earnings and a modestly raised 24 outlook are encouraging signs of relative stability. Stock is still lower by 0.7%. And your third and final call from CFRA upgrading Dollar Tree to hold with a price target of 109. Analyst Arun Sundaram seeing softness in its Family Dollar brand and risk tied to Dollar Tree's multi-price point strategy. Arun joins us now for more. Arun, let's get straight into this, sir, and thank you very much for being with us at a time when the consumer is very much front and centre in our minds, and we're trying to work out how different companies are gauging where this consumer is at the moment. Earlier on, we heard from McDonald's, and they say maybe this consumer is slowing down. We heard a similar story from the likes of Nestle, from Pepsi too. In the companies that fall under your coverage, what do you see?
Hey, thanks for having me. Yeah, we're also seeing a slowdown in spending. I think what's a little funny, in my coverage, I cover a lot of big box retailers and packaged food companies. A lot of these retailers have been seeing a slowdown in spending for the past 2 years. But I think we're talking about it more now because you're also seeing weaker spending in the services side of the economy over the last say a few quarters or so. But really spending on goods has been soft for probably the last 2 years, especially spending on discretionary goods, especially those bigger ticket discretionary items. And now that we're seeing a softness in the services side of the economy, we are talking about the softening of the consumer a little bit more. But we're seeing the same things. Consumers are trading down. They're opting for cheaper private label brands. They're even opting out of certain categories. In some cases, they're just being very choiceful, discerning in their spending. But like I said, that's been the kind of the trend for the last year to 2 years now for at least the big box retailers.
Well, it certainly reminds me of the difficulties that the likes of Target had over the last couple of years. If I go through some of the other companies in your coverage, Amazon, Walmart, Costco, when I hear trade down and more choiceful consumer, I think Walmart. Is that the winner in all of this?
Yeah, certainly. Walmart has been our top pick in the retail space for the last year and a half now. Walmart is gaining a significant amount of market share, not just in grocery, which is what they're predominantly known for, but also in their general merchandise categories. You don't really think about Walmart as being like an apparel retailer, a general merchandise retailer, but they're really growing out that general merchandise business, and predominantly because of their e-commerce platform is growing pretty significantly. They introduced a Walmart Plus subscription program. These are all high margin businesses for Walmart. And on top of that, Walmart's also growing out their advertising business, something that we don't really talk about a lot with retailers. But the advertising arm for many of these big box retailers are growing attractively. And that's a much higher margin business than selling core goods. And that's why I think that the stocks for a lot of these big box retailers are up, and I think a lot of it has to do with the fact that sales mix is changing, and they're not just being known for a goods retailer anymore. They're selling advertising, it's healthcare, it's financial services, and like I said, these are much higher margin businesses than goods.
And Arun, this is the reason why it's sort of a question of how do you get a view on the true consumer. Maybe Walmart isn't the cleanest read because of all these other types of businesses. Certainly Amazon isn't because of AWS, et cetera. With Dollar Tree, is what's good for Dollar Tree bad for the rest of the economy? Is it typically that when those types of companies do well, it signals real weakness for the rest of the consumer spending space?
Well, I mean, in fact, both these dollar stores, Dollar General, Dollar Tree, they've actually been struggling more than other retailers over the last year. And why? It's because they're more exposed to that lower income household, which, as is a little more exposed to the effects of higher inflation, higher interest rates. It's really the retailers that are more exposed to that middle income or higher income consumer is doing much better. So yeah, I wouldn't say that dollar stores are doing well in this environment. They've actually been I would say struggling in this environment. It's Walmart that's really gaining market share at the expense of these dollar stores. But our expectation is, these dollar stores will start to recover. I think in the second half of this year, with Dollar Tree specifically, they're like I was saying before, they're introducing this multi-price point strategy in their stores and introducing new price points. And I want to make it clear, it's not because they want to raise prices. They just want to introduce new assortment in their stores. So for Dollar Tree, 80% of their goods are still going to be at that entry level $1.25 price point. Just 20% of their goods are going to be at these higher price points, $3, $5, $7. That's a way to attract more consumers into their doors. And early signs are showing that it's a success right now. These stores where they have these multi-price point products, the consumer basket size is actually 2 times larger. So people are putting more items into their basket when these stores have these multi-price point products, which is great because we're right now in an environment where basket size has actually been shrinking because people have been putting fewer items in their basket. But for Dollar Tree, it seems like, at least with the stores that they have this multi-price point strategy, people are putting, more items into their basket.
I've been waiting for them to rebrand as $5 Tree, but evidently that's not happening. I am wondering, when you talk about Walmart and the likes of actually really gaining on advertising and on some of the online spending, how much they're actually winning market share, not just from other retailers, but from Amazon, the one that kind of coined the whole kind of online marketplace.
Yeah, I mean, Amazon's the big gorilla in the room, especially in the e-commerce space, and now other retailers are really trying to catch up. Walmart a few years ago introduced Walmart Plus. That was their subscription program intended to compete against Amazon Prime. We think Walmart Plus is so far been successful. Walmart doesn't necessarily release membership statistics on Walmart Plus, but we do see that Walmart Plus subscription base growing. Even Target, they're a little bit late to the race here, but just a few months ago, Target introduced their own membership program called Target Circle 360. Memberships are really a way to drive consumer loyalty and drive traffic into their stores. And it's also a way to grow margins and reinvest in your business. So I think you're going to see more retailers try to offer these membership programs. The problem is that, how many memberships can a consumer subscribe for? So there are clearly going to be some winners and some losers. I think the retailers that are going to be winners are the ones that have a very wide assortment of products. So the Amazons of the world, the Walmarts, Costco is they're also a subscription program given their warehouse model. But I also believe Target is also going to be a winner of the subscription program. And like I said before, these subscription programs is also a way to grow your e-commerce business, which also will help you grow your advertising business. And right now, advertising is where the margins really lie. And these retailers are really leaning into their advertising business to try to help grow profits.
Just amazing. Just an amazing turnaround. I appreciate the update, sir. Arun Sundaram there of CFRA. Just kind of frame it at the end there. How much of a challenge these companies have become to the likes of Amazon to hear the advertising business. And I know we've heard this before, but the ad business becoming a bigger part of some of these companies.
Yeah, and Walmart's really been ramping up its online presence in a much more significant way. I love how some of these consumer-facing companies are increasingly anything but consumer-facing companies. Airlines are actually credit card companies. You have Walmart's, for the retailers, are actually advertisers. It's sort of like, it's not really good to just be consumer-facing. We also have 15 other businesses. Check them out.
Things have changed. Things have changed a lot. Equity futures right now positive by 0.5%. 1 hour away from the opening bell. The lift continues. We'll catch up with James Camp of Eagle Asset Management and Zach Griffiths of CreditSights. We'll catch up with them just after the commercial break. So I mentioned this stat on Friday, and if you missed Friday, you went to the beach early, good for you. I'll repeat it again. This is for you guys. The Mag 7, this is from Deutsche Bank. Mag 7 down 12% from its peak 2.5 weeks ago. The Russell 2000s outperformed it by around 25 percentage points over that period. Jim Reed, Deutsche Bank. That just kind of frames how vicious this rotation has been over the last few weeks.
And some people say it's just simply because we're dealing with how underpriced some of the small caps have been versus, say, some sort of statement on this incredible growth wave. Other people say this is the beginning of a really good period of time for the cyclical stocks at a time where the Fed's going to be cutting rates.
Can it continue? It continues this morning, up by 0.8% on the Russell. The small caps continue to rally. Large cap tech does all right as well. The Nasdaq 100 up by 0.8% on the S&P 500 up 0.5%. A massive week for big cap tech. Some big earnings tomorrow. Microsoft, Wednesday, Meta, Amazon and Apple coming on Thursday. Switch up the board and get to the bond market. The 2-year big rally last week. Yields dropping 12 basis points. We drop another single basis point this morning. 437.50. It's not just the Federal Reserve decision on Wednesday you've got to confront. It's the data through the week, including payrolls on Friday.
You nailed it. The good kind or the bad kind of rate cut. Because at this point, we seem to be having this you can have your cake and eat it too kind of moment. Or some people would call it Goldilocks. This idea that the economy is softening, not soft. You're ending up with a Fed that's cutting rates proactively to expand the cycle, good for small caps, and lets yields go lower. What could potentially gut check it? Well, either a labor market that comes in weaker than expected, or the idea that issuance pushes up yields at the long end. You get some sort of disruption that kind of challenges some of the Goldilocks narrative that we've been hearing.
And if this wasn't enough, you've got to grapple with the politics as well, which is just as messy. Still can't figure out 25. Terry Haines of Pangaea came on earlier in the programme and he said basically in his notes that it's quite simple. He thinks that Harris wins and you have a split Congress and you can move on with life.
Okay.
I'm not sure things are ever this simple these days.
And then what does that mean for a policy perspective? I mean, what a lot of people in markets, great, you can come out with that. It's almost easier to talk about this poll is saying this and this person's doing this than, okay, what does that mean for markets? And we had, Kevin Gordon on. He just said, the best thing you could do is just keep politics out.
Everyone's calling it the honeymoon period. I think we're going to call it the relief rally of the Democratic ticket. Their stock is just rallying because the former CEO dropped out. Not my framing, someone else. I can't remember who said that, but it's a great way of framing it. Now we need to see, what's your plan? What's your plan after you've had that initial bump?
Yeah, who are you bringing in, too, to be your running mate? How moderate will the person be, and which states will they be catering to kind of reshape? Are we talking about a blue wave that's important, the sort of Rust Belt states, or are we looking beyond that to other places as well? What happened to Andy Bashir? I mean, I don't know how The Bachelor works. I mean,
where did Governor Walz come from?
I mean,
where did that come from?
Maybe it's the wild card. It's like the wild round. What is it? Okay. I don't know. You're more familiar with Bachelor than I am.
No, you've been watching it too, haven't you? Bachelorette.
Some, yeah,
no, I just know the roses bit.
Yeah, I just know the roses, but I don't know how it's selected.
There's a wild card round.
I don't know. I'm just making things up right now. Let's move on.
You can't make stuff up, Bramo.
Oh, come on.
It's important TV. Yep. Let's get to the FX market. Dollar yen, 153.95. What are you doing? Up by 0.1% on that currency pair. So we've got the Bank of Japan on Wednesday. This came from JP Morgan. They're looking for a hike to 0.25% at the BOJ, and they're looking for a big cut in bond buying as well. The key issue to watch may be the terminal rate level the BOJ has in mind and the time frame for it. Here's the quote from them. It will be a test of whether the BOJ will make policy decisions based on its assessment of the economy and inflation in a forward-looking manner, or will refrain from policy changes unless responding to immediate market pressure. What kind of BOJ have we got here?
Well, that's a great question. People are wondering how much they're really going to cater to the yen versus worry about the fact that consumers are showing some signs of weakness. Really, the key is going to be, and this is Pantheon Macro, he's saying the balance sheet could potentially be the most important, Ian Shepherdson over there, because essentially they could stop buying so many bonds but keep rates where they are, not hike them right now, and that might be sufficient for markets. We'll see. I think from a market perspective, the Bank of Japan might be more consequential than the Fed this week.
Possibly, given that they actually might change something this week as opposed to the Federal Reserve, who aren't set to change much at all. But we'll see. So we've got dollar yen down to about 153.93, just short of 154. Last week, that currency pair down by 2.36%. Down 2.36%. So that's the biggest week of yen strength that we've had going back to May of this year, I believe. Under surveillance this morning, our top story for you, one of them at least, presumptive Democratic nominee Kamala Harris raising $200 million in her first week as a candidate. This is a new ABC News poll, shows Harris's favourability rating rising 8 percentage points to 43% since President Joe Biden's decision to drop out a week ago. And now it's Veep stakes. So let's talk about some of the names. Governor Shapiro of Pennsylvania still in the running. Senator Kelly of Arizona still very much in the running. And then Governor Walz seemed to come from nowhere as a top three reportedly over the weekend.
Yeah, from Minnesota, which is a state that Donald Trump is going after. I am curious about what the goal is for one of these potential candidates to bring. Is it the idea of a more moderate voice? Is it just simply the location that they're in? Is it to try to bring in certain states that are on the fence? I'm curious how it's framed in terms of a ticket that is a policy prescription in some capacity, because people still don't have their head around exactly what a Kamala Harris presidency would look like and whether it would be different in any way, shape or form from a Joe Biden presidency.
Things have changed a lot. When we were talking about the prospect of Biden still running, we were talking only about the Rust Belt. That was the path to victory. Then we had this conversation earlier this morning, I think with Jeannette Lowe of Strategas, which basically talked about how we've opened up the Sun Belt again, and we can start having real conversations about places like Arizona, which speaks to Senator Kelly. I guess we'll see. Based on the conversations we've had repeatedly over the last week, feels like Governor Shapiro is still right up there as the leading candidate, but who knows?
Yeah, especially because Kelly has some experience with international sort of foreign affairs issues. I'm curious where the emphasis goes on that as well. But whether it's just simply a swing state or if it's something more in terms of policy, will be interesting to watch.
We had some news overnight on the Apple front. I want to bring that news to you. So the upcoming AI features are now expected to be rolled out just later than anticipated, which is all a little bit odd. So if you put it all together, we've got these AI features. You now have to wait for the software update that's going to come later this year, but you'll get the hardware update before all of that when the iPhone launches in September. Is that the right chronological order of things?
The hardware update isn't that significant, and it's not that big of a stylistic kind of increase. It really was supposed to come from the software update, which would include some of this AI technology. Put it all together, there was one bellwether that we were watching, which is whether Jonathan Ferro would actually upgrade his phone and buy into it, and that would be the trigger.
Big data point.
That would really signal that, yes, the upgrade cycle is beginning. And it sounds like there's some skepticism about the John Ferro schedule.
I don't think I'll be upgrading in September.
Oof, you heard it here first.
It's not going to have the goodies. But then once you get the phone, then you just wait and then you sort of like, it gets updated in a month later or something like that.
Yeah, I mean, you'll actually get the upgrades. But my question is, what are the upgrades? What will AI provide that you're not getting currently in search and other ways that we don't even realize we're having certain AI-infused programming? I don't know exactly how well it can be. It's sort of personalized Bitmojis. And
is that what they're touting?
I don't know.
Okay. Apple's down by about 0.1%. That's not getting me to upgrade. Let's put it that way. Big week of central bank decisions coming right up with the Fed very much in focus. The FOMC widely expected to keep rates on hold this Wednesday, but set the stage for a September rate cut. Joining us now to discuss is James Camp of Eagle Asset Management alongside Zach Griffiths of CreditSights. Gents, great to catch up with you both. Zach, I want to come to you first, sir. Give us a read on what you're expecting this Wednesday and how it might set us up for what could happen in September.
Yeah, John, we are looking for the Fed to make adjustments to its policy statement to indicate more of a concern in terms of the labor market, or at least dial back their assessment of strength in the labor market and continue to emphasize progress on the inflation front. We expect Chairman Powell to indicate a willingness to cut in September. We don't think he'll be very explicit in saying that they will cut, but keep options open, keep that data dependent mantra. We think the data supports a cut in September.
James, of course, we're all much more interested in the 100 basis points after that, if there is a 100 basis points after that. What is the destination you think this Fed is heading towards, and what kind of economic regime do you think we're in that guides that?
Well, good morning. Good to be with you. We're in a reflation regime, right? The anchoring that we had in the post-financial crisis period up to COVID is gone, and we have a new economy. And that new economy has more stubborn inflation. And we've written about onshore, we've written about pricing power, we've written about a tighter labor market. I think the Fed does cut in September. This is the clearest data that they're going to have to give them that opportunity. But the base effects and some of the inflation inertia is going to come back in the fourth quarter. So I don't consider this a Fed pivot. I consider this a Fed sort of getting back to sort of more normal on the funds rate. But I wouldn't extrapolate this September meeting, which is likely to be a cut, maybe even 50 basis points, into a protracted policy adjustment over the next couple of quarters. This is a late 2025 kind of phenomena where we'll see what the terminal rate will actually be. But that number's not imminent.
Hold on a second, James. Did you just say that there's a real possibility that the Fed will cut by 50 basis points in September?
Yeah, I do think that's the case, Lisa, because I think that this is going to be the clearest data that they'll have to give them the inflation cover. And I think they've wanted to move the last couple of hikes off the table. So I think this is the window. This is a kind of a little bit of spitballing with the inflation data. But we know if we look at the data series, it's not going to get easier to make the inflation case in the back half of 2024.
Okay, so this is basically they have an opening. So let's go full. I mean, Zach, what do you make of that? Do you think that that's a feasible possibility that the Fed's going to cut by a 0.5 percentage point?
That's not our base case, Lisa, and I think that would perhaps spook the market a little bit in terms of that big of an adjustment when just a couple weeks ago, policymakers were saying they need to see a lot more data in terms of being confident we're sustainably moving back to 2%. So I'd almost think of that as having the same impact as cutting this week, showing the market perhaps there's more to be concerned about. So that's not our base case. We do think the Fed is going to be easing at a steady clip once they go in September, really trying to bring that policy rate back towards something that looks at least a little bit more like neutral. We think we're coming from a pretty restrictive rate now, which is not what the economy needs. We're seeing signs of slowing, especially in the consumer. We expect that to be a bigger market driver in the second half of this year and into 2025.
Zach, just to be super clear, are you making a growth call here, not an inflation call?
Well, that was a call on growth coming down. We think moving back toward below potential is what you're going to see over the next 12 months. We've had extremely strong growth and still had inflation come down quite a bit. So we think with inflation where it is, the Fed starting to ease, we're already seeing signs that the economy is cooling. We think that continues and starts to have a bigger impact from a fundamental perspective on where credit spreads go from here, which is why we're in a bit more of a defensive camp than we have been for much of the past 2 years.
You've set us up with the market conversation. Let's go there. Let's stay on it. Zach, if you're looking for wider spreads potentially, where's the 10-year? What kind of level of credit spreads are you looking for into the growth slowdown that you're expecting is going to trigger quite an easing from this Federal Reserve?
So we're looking for the 10-year to go back to 3.25 at the end of the first half of 2025, John. So that's a pretty big move lower from where we are today. And we have investment grade credit spreads going to 120 basis points, high yield to 400 basis points. So not a terribly huge move in terms of spread widening, as we think the technicals, the cash on the sideline, and plenty of cash that we think wants to be put to work in other asset classes provides an offset to more of this fundamental concern we're expecting to be driven by a more notable economic slowdown than what's currently priced into consensus expectations at this point.
This is great because both of you kind of highlight the two sides of the debate right now. And that I think is a wonderful thing to have. James, it seems like you're more constructive. You think that the Fed is going to cut for the right reasons. They have an opening to do so to prolong the economic cycle. Zach, you seem a little bit less constructive. James, what makes you think that this is going to be a good kind of rate cut in the sense that it's just simply to adjust policy mid-cycle to allow growth to continue?
I think there's two financial conditions we have to look at. For large cap, big companies, financial conditions are extremely loose. For down market consumer, this is the bottom 80% of our income strata. Credit card debt is high. Credit card payments are high. And the Federal Reserve policy has directly impacted those down market consumers. The credit conditions in the capital markets are still loose. Equities at all-time highs. The VIX low, credit spreads, as your other guest just mentioned, very, very tight. We have a very bifurcated economy. And I think the Federal Reserve has to be mindful of the fact that housing affordability is at 40-year lows, that the down market consumer is under significant strain. We saw that with some consumer discretionary earnings this morning. So I think this is more an opportunity in a window to kind of get right or closer to where the policy should be. But I will tell you that the inflation data is not going to be constructive in the back half, and they're not going to have this sort of wide open field to begin a real significant easing cycle for the next couple of quarters.
Well, James, though, do you agree with Zach that means probably wider credit spreads than you could end up seeing maybe a little bit, and I'm just extrapolating here, putting words in Zach's mouth, he can correct me, but basically potentially a reversal of the small caps and a sort of reversal of just sort of this belief in a cyclical trend. Do you think that we're going to see that kind of response, or do you think that people are going to welcome some sort of adjustment by the Fed as allowing that to sort of right-size itself, to allowing the cycle to continue?
Yeah, I think it's the latter. And I don't think corporate spreads are bound much wider from here. There's a lot of demand. We know that at peak Fed, which we certainly can both agree, I think we're at peak Fed, that corporate credit, that municipal credit, that bonds outperform every time. Go back to 1989, you have 5 Fed tightening cycles. And at peak Fed, you have great returns to fixed income, and you have great returns to dividend growers. And as you mentioned, that rotation that began July 11th, with the more benign inflation data into small cap out of mega tech, that has also buoyed the dividend trade. So what we have now is a very generous income market for investors, and we also have a market that will be underproductive for cash. Cash yields today will not be cash returns over the next 12 months. So clients and investors that have money to invest, the income space looks extremely generous, both on the dividend and on the debt side.
Zach, I want to give you the final word. You can use your own words. What's your response?
Well, I think the huge differentiator here is, are you a total return or excess return focused investor? We think the next 12 months look very solid from a total return perspective. If you're focused on that excess return and that credit spread component, it's a little more difficult. And so overall, we do think it is a positive environment for fixed income, but starting to see that spread widening. If you're a credit and excess return focused investor, you need to keep an eye out for that.
Gents, this was great. Zach Griffiths of CreditSights, James Camp of Eagle Asset Management. Thank you very much. Looking ahead to a massive week with the Federal Reserve and all that data coming right up.
You know what we didn't even get to? The quarterly refunding announcement. And you know who's going to talk about that? Zach Griffiths. So we'll have to have him back sometime, because he was saying it's actually really significant. He said that actually could be, market moving.
OK, is Zach still there? Can we find out? Is he still there? Or have we let him go? They're going to find out for you. All right, we can do this in real time. You changed the whole show.
All right, we can let it go.
He's good. He's here right now.
He is?
Yeah, I've got him back in. Go for it. You want to bring him in?
Yeah. Zach, just quickly before we let you go, and we brought you back on just for this, how important is the quarterly refunding announcement?
We think it's important, but we're not expecting any major changes this week. I'd be focused on what happens this afternoon with the quarterly borrowing estimates. I think that's more likely to surprise the market than what we hear on Wednesday morning, but that's going to be huge. There's a lot of focus on it now. It's something I've focused on for many years. I'm surprised to see how much it's in the market. Overall, no change. We're not expecting that to outweigh the shift in monetary policy and the economic landscape, which pulls yields lower.
Well, that was anticlimactic. Thanks for jumping back, Zach. Appreciate it. Thank you. Zach Griffiths there at CreditSights. I'm going to go now, OK? Let's get you an update on stories elsewhere. With your Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. A check on McDonald's shares in the pre-market up more than 1%. Sales declined for the first time since 2020 from international to U.S. locations. Each of McDonald's geographic footprints saw sales declines for an overall drop of 1%. The estimate was for a 0.8% growth. The company's CEO said consumers were being more discriminating with their spend. McDonald's and its competitors are now offering discounts to lure back customers. McDonald's latest is a $5 meal deal that it launched last month. And another attack has occurred on France's infrastructure during the Olympic Games. This time, a number of fiber optic cables were cut overnight. The cables carry broadband services across France's southern and eastern regions. Orange, the Olympic telecom partner, said the connections into Paris, and thus the Olympics, were not affected. Just on Friday, coordinated fires on French rail lines had disrupted trains ahead of the opening ceremony.
And Disney's Deadpool and Wolverine shattered box office records this weekend. It brought in $205 million. The superhero buddy film scored the best ever opening for an R-rated film, with more than twice the ticket sales of 2019's Joker during its first weekend. The latest entry in the ever-expanding Marvel Cinematic Universe continues Disney's hot streak. This summer, after Pixar's Inside Out 2 grossed almost $1.5 billion since its June release. And that's your brief. John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for a big week ahead from New York. You're watching Bloomberg TV. The opening bell for the first trading day of the week, about 40 minutes away. Equity futures going into that positive by 0.5% on the S&P 500. It's a long week. A busy one, that's for sure. In the bond market, yields are lower by 3 or 4 basis points on a 10-year, 4.1569. In foreign exchange, the dollar showing a bit of strength against the weaker euro, 108.16. We're negative on that currency pair by 0.4%. A lot of focus will be on dollar yen. Dollar yen having 4 consecutive weeks of yen strength for the first time this year. Coming into Monday, we're down to about 153. Positive this morning by a tenth of 1%, 153.88 on dollar yen. The trading week looks like this. This is the lineup. Tuesday, JOLTS and consumer confidence data. Wednesday, ADP plus a decision from both the BOJ and the Federal Reserve, followed by a Chairman Powell news conference at 2:30 Eastern Time. Thursday, we'll get another round of jobless claims plus a Bank of England rate decision. Friday, US payrolls report, tons of earnings in between, results coming from Microsoft, Meta, Apple, and Amazon. And just for Lisa, drum roll, the quarterly Treasury refunding also coming up on Wednesday. Mike McKee drops by to give us his thoughts on the data for the week ahead. Mike McKee, good morning, sir.
Good morning.
All that data, just where is this economy right now going into this Fed decision on Wednesday?
Well, I'll talk to you on Friday when I see all this data.
Come on, work with us.
The economy is in pretty good shape. It's slowed down. It hasn't crashed. Inflation is coming down according to all of the latest data. And Fed officials who've been talking to CEOs say that people are still relatively optimistic. So we're probably set up for the Fed to hint at a rate decrease ahead. I was kind of thinking last night, it's a bit like one of those gender reveal parties where maybe we give Jay Powell a piñata and he hits it, and instead of boy or girl comes out as September or November, and we see which one they're actually going to do.
Is that an actual recommendation for the Federal Reserve? You're going to give that to Chairman Powell on Wednesday?
The ratings would go up. A lot more people would watch you.
I imagine they would. Thanks for that, Mike. We've got to do gender reveals. Every payrolls Friday, every Federal Reserve.
I mean, between the Bachelorette that's going on with the Vice President's stake, and you've got, gender reveal for the Federal Reserve, what kind of country are we coming to?
If you were going to schedule this for ratings, though, I'd have payrolls on a Wednesday and the Fed decision on Friday.
Exactly.
Wouldn't you?
But that's a problem for the Fed because they don't know what's going to happen. And if we do get a 0.1% rise in unemployment to 4.2%, that should trigger the SOM rule. And while the Fed isn't particularly worried about it, it'll obviously worry the markets, and it'll be, are they now going to be able to cut? We'll have the Fed say whatever they say. Markets will adjust on Wednesday. And then Friday, it may be a whole new story.
Okay, just going with the gender reveal party, that's not going to happen anyway until Jackson Hole, right? I mean, we're not going to actually get anything from them. I mean, we've been basically setting up that Wednesday is going to basically be them saying we're data dependent. Any data point could be live and could really tip us over the edge. Is that not what we're going to hear from them?
I think they pretty much have to give some sentiment about September because the market's all focused on it. If you're waiting till, why do you wait till Jackson Hole? You don't really need to. If they think that rates should go down now, you can say you're going to cut rates in September or hint strongly at it, and then rates are going to go down because people are going to start pricing it in. So you get the effects of a rate cut. And you've got a lot of people like Mohamed El-Arian, Alan Blinder today saying the Fed needs a cut right now.
They should ask Christine Lagarde what it is to pre-commit to a cut and see whether or not they actually want to do that.
Well, that's why they'll dance around it.
Right.
They won't say September.
Correct. Maybe we could ask Christine Lagarde. There is this issue, though, of some of the sleeper data points that we get. JOLTS data. We also get ISM manufacturing. What are you watching in terms of some of those sort of tertiary indicators that could be as telling or market moving as some of these other bigger data points?
Well, we're watching ECI, which is on Wednesday as well, because the Fed follows that in terms of pay and compensation and whether that's putting upward pressure on inflation. And it's been coming down, so we'll see if that continues to happen. Obviously, ISM manufacturing, we'll look at the sub-indexes there about new orders, see what it looks like going forward, and prices paid. And jobless claims. Everybody wants to know what's happening with the labor market, so that'll be interesting to see. But obviously, jobs Friday, the big day, the big data of the week.
Just short of 180 is the estimate, the median estimate in our survey. I think it's 178, Mike?
175 or 178, yeah, it's been bouncing
the
around.
170s, as that changes as we get more estimates and they come through into our survey. Mike, great start to the week. Appreciate it, sir. Mike McKee there on the latest. Massive week ahead.
Yeah, that might end up with a gender reveal that says December or September, and it will be September. You know, honestly, it is a massive week, and I think we've really broken it down to the idea of economy. We've got decisions from central banks, and we have earnings. Everyone's been saying earnings so front and center, given how much of the index is going to be reporting this week.
Light on politics. How relieved are you? Very.
Anne-Marie's not even here. She's like, peace out.
You're going to get a vice presidential nomination.
Yeah, exactly.
Even Anne-Marie's taken a week off.
Yeah, exactly.
Like that tells you everything you need to know about politics.
It'll insert itself somehow.
I have no doubt it will. Coming up tomorrow, here's the lineup. Bob Dole of Crossmark, Mona Mahajan of Edward Jones, Matt Hornbeck of Morgan Stanley, Tiffany Wilding of PIMCO. Have a wonderful week, a busy week ahead of us all. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.